Very good morning, friends. So I hope your preparation is going good. So today we're going to start with the trail of, I would say, consolidation standards. Now, why do I say it's a trail of consolidation standards? Because there are plethora of standards which are there as far as consolidation is concerned. You already know it's Index 103, starting with a business combination. Index 110, which is on a consolidated financial statements. Index 28, which talks about associate and joint ventures. Index 111, which talks about joint arrangements. And of course, Index 27, which talks about the separate financial statements. So, in these coming 4 sessions, we are going to devote time in terms of covering the concept of all these standards relating to consolidation. Today, of course, I'm going to start on my journey in terms of Index 103, that is business combination. So as usual, we're going to make some mind maps, connecting all the dots, revising the concept first of all, and then we're going to do some questions also as we move on. So in these particular mind maps, we're just going to recall the concept. Of course, we're not going to get completely in details on each and every concept as usual, because the idea is to just connect some mind maps so that you can go through them before the exams and collectively just recall the major concepts out there. So I'm going to start my journey with the very first mind map, and that is connecting all the standards so that we know that which standard applies when. And in between this mind map, we're also going to talk of certain tests, as you know, that when do you identify that it is supposed to be a business. So let's begin with the mind map number 1. So I'm first of all going to make a mind map number 1. So in the very first mind map, I'm just going to connect all the standards relating to the concept of consolidation. And in this particular case, I would call this as that we are connecting these standards. So I think I'll just call this as that we are connecting the standards. So all the standards will get connected out here. So I'm calling this as a very basic mind map. So we're just connecting all the standards relating to consolidation. So we're going to first of all map the 3-step model in the mind. The first thing is that if a company A acquires something from company B, you need to first of all ask yourself, what did they acquire? That is step 1. The step 2 is then to identify that whether it is a business or not. And the step number 3 is in terms of identifying that did A get a control over B or not. So the focus in terms of step 1 is what did you acquire? The focus in terms of step 2 is that a business? And the focus in terms of step 3 is did you get a control or not? So we just keep at the background an input regarding A and B. So I think let's just put this in the background, that we're considering that there is a company A which approaches company B. So we're looking at a 3-step, what kind of questions we need to put across. So when I say the very first step in this case is to put across a question, what did A Limited acquire? So the very first question you will put across is what did A Limited acquire? So he could land up acquiring either an individual asset or he may land up acquiring a group of assets. So he may land up acquiring either an individual asset or he may land up acquiring what is called a group of assets. So when you say it is an individual asset, then what should come at the back of your mind is that a tangible asset or is that an intangible asset? So we need to see that is it a tangible or intangible asset. And of course, I am considering the acquisition of a non-current assets out here, not the acquisition of current assets. So when you say that it is an individual asset, it could be tangible or intangible in nature. Now, when you say that it is tangible in nature, I think you can quickly remind me which standards would get triggered. If it is supposed to be a tangible assets in nature, then can I say the standards which could trigger is either 16 or 40, depending upon the parameters which might be met. And if it is intangible, then it is Index 38. But the consolidation standards, of course, would not trigger. So the acquisition of individual assets would never trigger the concept of consolidation. So what is important in step one is you need to acquire group of assets. So the moment you say, yes, it is a group of assets, we're going to go to the step number 2. So this is what we're trying to recall, that what did A acquire is the very first thing which we need to identify. That was correct. Now we go to the step number 2. And in terms of step number 2, now the focus is the group of assets which A acquired from B, is that a business or not? So we need to identify that is the group of assets. So we need to identify that is the group of assets. We need to identify that is it supposed to be a business or not? So we need to identify that is the group of assets supposed to be a business or not. Now you already know this, so I think I can map it out here itself. When you're identifying that group of asset is a business or not, we need to apply Index 103, where it gives you two kinds of test. One is called a concentration test, and one is called the 3-element test, what we call IPO test. And I think let's make the mind map within this out here itself. So when you say that it is a business, you need to apply the parameters of Index 103. And in terms of Index 103, you know that there are two kinds of tests. The first test is what is called a concentration test. The first one is what is called a concentration test. And the other one is what is called the 3-element test. Or you can also call it as an IPO test. And the 3 words IPO, it stands for input, process, and output. Now, I think let's just connect some dots. What is the treatment with reference to concentration test and the IPO test? Now, this concentration test, as you would rightly remember, is completely an optional test. So what are the permutations and combinations which could trigger? The company chooses, yes, I'm applying a concentration test, or the company says, no, I'm not applying a concentration test. If you say, no, I'm not applying a concentration test, then in this particular case, you have to, on a mandatory basis, apply the IPO test. And if you choose to apply the concentration test, then in this particular test case, either you pass the test or you fail the test. Now, in a situation where you pass this particular test, then in this particular case, we reach a conclusion that it's not a business. It is supposed to be an asset acquisition, and it is not a business. But if you fail this particular test, then again, it's a mandatory testing in terms of IPO. So we know that there are 3 combinations. You say, no, I don't want to apply the concentration test, IPO test. You apply the concentration test and you fail the test, IPO test. You apply the concentration test and you pass the test, we reach a conclusion it's not a business, and then the IPO test is not applied. So we'll quickly also go through the concept of how the concentration test is conducted. That I'll just come to that later. Okay, then when you look at the IPO test in this particular case, if you pass this particular test, you reach a conclusion that it's a business. I'm putting it as B. And if you fail this particular test, then it is supposed to be an asset acquisition. I'm putting it as A. So this is the inputs, what you need to remember in the step number 2, that there are 2 tests, optional concentration test and a 3-element, or what we call the IPO test in this case. Now, coming back to the dots. So when you say that is the group of assets a business or not, you applied these particular tests, and if you say yes, it is a business, or you say no, it is not a business, then it is supposed to be an asset acquisition. If you say it is not a business, then it is supposed to be an asset acquisition. And if it is supposed to be an asset acquisition, then you would apply Ind AS 16, Ind AS 40, or 38, as the case may be. Once you say the group of assets is acquired for paying a consolidated consideration, split the consideration between the individual assets in the ratio of relative fair value. So in this particular case, what you need to basically do is you need to split the purchase consideration. You need to split the purchase consideration in the ratio of, you can say, relative fair values of all these assets. Because it's a group of assets, but it's not a business. So the first thing what you need to do is the total consideration paid is divided, allocated to the various assets in the ratio of relative fair values, and then the relevant standards on the individual assets would trigger. Now, when you say yes, it is a business, then it's time to go to the step number 3. Okay, so that is on the step number 2. Now let's go to the step number 3. Now, step 3 is the main step which is going to give you the triggering inputs that in which combination, which standard is going to apply. So in this particular case, we need to see, did A Limited acquire control over the business? Did A Limited acquire a control over the business of B? So you acquired a group of assets which you call it as a business. Then the next focus is to see that did A Limited get a control over the business of B Limited or not. Now here the focus is on the word control. And when you look at the concept of control, control is based on Ind AS 110. So you make your assessment on the basis of Ind AS 110. Now, generally, when you're looking at a control, we follow the concept of a rule-based assessment, where you just see that if A has got more than 50% of the voting power in terms of equity or ordinary shares, we say there is a control. Though we know that as per Ind AS 110, it is supposed to be a subjective assessment. So we can say that, generally, or we can say basically, we go with a rule-based assessment. Basically, we go for a rule-based assessment, though it is, of course, subjective. You know the details, that what is the subjectivity involved. And in this particular case, we say that if you get 50% plus VP, that is voting power, the control is present. So in step number 3, the control assessment is based on the parameters, the principles which are laid down in Ind AS 110. Now, once you evaluate that did A get a control or not, the answer could be a yes, or the answer could be a no. Now, if you say the answer is a yes, then in this particular case, there are 3 standards which are going to trigger. And let me, ask you, which 3 standards would trigger when you reach a final conclusion? You're saying you acquired a group of assets, focus 1. You said it is a business, focus 2. You said, yes, I'm getting a control over the group of assets called a business 3. Then which standards would trigger in this case? Ind AS 103, business combination, that is 1. Then there is going to be Ind AS 27. This is business combination. This is separate financial statements. And you're going to apply Ind AS 110, which is on a consolidated financial statements. And that's rightly given. So let me now, ask you one very important question. That Ind AS 103, is it a standard applied every year or is just applied once? So Ind AS 103, which is supposed to be a business combination standard, is it going to be applicable year by year or just applied once? And that's right. So this is going to be applied just once. It is applied only once, and that is on the date of acquisition. But these two standards are going to be applied year by year. So these are the standards which will be applied every year end. So these standards will be applied every year end because you're going to make two financial statements, your separate and the consolidated financial statements to be prepared every year end. And if you say no, then in this particular case, you need to apply a sequencing of questions. If you say a no, we need to apply a concept of putting questions in a sequence. That if you did not get a control, maybe you get a joint control. And if not a joint control, maybe a significant influence. And if not a significant influence, then maybe it is a case of a passive investment. And I think, let me tell you one thing, that if it is not supposed to be a control, 103 cannot trigger. So 103 triggers only when it is a case of a business with a control. But if it is not a case of control, 103 definitely does not trigger. So I think if you just try to map the things, would Index 27 apply in this case? Yes, but not in terms of passive investment. Then in terms of consolidated financial statements, here it would be 111, here it would be 28, and in terms of passive investment, no consolidation, but the standard on financial instruments, that is 109, would trigger in this case. So I think that gives us a complete quick revision in terms of the interactions of the standard, that which permutations and combinations would a given standard apply. Mapping 103, 27, 110, 28, 111, and indirectly, of course, 109 as well. Now, this was the first mind map within which we are now yet to discuss the two sub-mind maps, I would say. One is the concentration test and one is the IPO test in this case. So let's, I think, first of all, map our mind on the concentration test. So I think I'll just maybe add on a sub-mind map within this. So this is within the mind map one itself. So this is my sub-mind maps. This is my sub-mind maps for the mind map number one. So within the interaction, let's keep this as a sub-mind maps. We've got two inputs. One is we're looking at a concentration test. One is we're looking at a concentration test. And the second is we're looking at the IPO test, what you can call as a three-element test as well. Input, process, as well as output. Okay, now I think let's begin the journey. When you apply a concentration test, because this can definitely be tested very easily, if not a larger question, maybe a simple MCQ kind of a question as well. So in this case, again, we applied a three-step model. For the concentration test as well, we apply a three-step model in this case. Number one, you need to first of all identify the individual asset or maybe a group of assets which are similar, which has got the largest fair value. And then you need to thereafter calculate what is called the gross purchase consideration. So what you're going to do in this particular case, in step number one, you need to identify, you can say the individual asset. You need to identify the individual assets, or you can say group of similar assets. You need to identify the group of similar assets. And that is which has got the highest fair value. So identify that single asset or identify the group of similar assets which has got, you can say, the highest, largest fair value. Identify that. Then the second step is in terms of identifying the gross PC. So I think let's do this in stages. Let's do this in stages, and that is step number 2, A, B, C. So first of all, what you need to do, you need to add up the three elements in step number 2, A. You add up the purchase consideration, you add up the previously held interest, and you add up the NCI. So the first thing you need to do is add the three elements. Add up the purchase consideration, add up the previously held interest, and also add the NCI, which makes 100% payment for the entire business. So if you remember, the step number A will give you what is paid for the net assets in entirety. Then whatever value you've calculated in A, you're going to add back the liabilities. Because we need to get what is paid for the assets only. So first you get what is paid for the net assets in entirety, then you get what is paid for the assets, and then the value which you get in step number B, we reduce the cash and the cash equivalents included in this. So once you get this, you come to know what is paid in terms of the assets, that is as a whole. And then in terms of step number 3, you take the value in step 1 as a percentage of the value in step 2, and if it is substantial, I think let's ask you now, if it is substantial, you say yes, it is substantial. Then what do we say? Is it a business or is it an asset acquisition? You take the percentage of that individual asset as a percentage of the value in step number 2. It turns out to be substantial, generally 90% or more, but there is no defined percentage as such. Then what is the conclusion in that case? So if you pass this test, it becomes an asset acquisition. And if you say no, then it's time to go to the IPO test in this case. That's right. So this is on the concentration test on a quick level. Then we come to the aspect as far as the IPO test is concerned. Now, in terms of the IPO test, you need to apply again, I would say, a 3-step model. So here in terms of the IPO test, you need to apply a 3-step model. And in this particular case, when you apply a 3-step model, at the first instance, your focus is that did we acquire both? Did we acquire both? You can say input and process. The output, of course, is not necessary at this stage. So your focus would be that did we acquire both inputs and the process? If you say yes, we go to the step number 2. And if you say no, then in that particular case, it's an asset acquisition. It cannot be a business, undoubtedly. Then in terms of the step number 2, you just need to see that is there output or not. So I'm just putting it as, is there output or not? So did you acquire the output or not? So irrespective, you say a yes, or irrespective, you say a no. In both cases, we said we'll go to step number 3. So your focus in terms of the step number 1 is input process. Output is not necessary to be seen in step 1. Then in terms of step 2, you focus in terms of output, is there or not? And I can just, let's quickly put this out. When you say output is there, and when you say no, output is not there, so would you like to remind me how many inputs do you need to see? Remember, I gave you that if there is no output, we're a little more stringent in terms of evaluating the parameters. And if you say, yes, there is an output, we are less stringent. So I'm just reminding you that there were 2 conditions or a set of 1 condition which you need to meet. So either you meet the 2 conditions or you meet the 1 conditions, and we would say, yes, it is a business. And if there is no output, then there is a total of 3 conditions which you're required to meet. I think if we just quickly run through those conditions, the 2 conditions in this particular case is number 1. Rather, let's first define these 3. The 3 condition is that you, first of all, acquired an organized workforce. You acquired other inputs as well. And the processes are critical. So what do you need to identify in these three conditions? It is critical you acquired organized workforce and number 3, other inputs as well. In this case, the 2 conditions is the process is critical and you acquired an organized workforce. And the 1 condition out here is that the process is something which is unique, which is scarce, and therefore you would say that yes, it is supposed to be business. You meet these two or one or three conditions, it's a business. You fail them, it's an asset acquisition. Right, friends. So I think that gives us some quick mind maps to begin with. So I think I've taken the first mind map with two sub mind maps. Now we should be clear on the connection of the standards, the concentration test three-step model, and you can say the IPO or the three-element test. I think now let's do one question on a concentration test. Maybe you can help me in getting the answer. So let's begin a journey and let's do some practice on this. This is one of the questions which is there in the study material as well. So you're going to see some super 20 questions coming in again. Let's, I think, read the question and then we're going to work on the concentration test in this case. I hope it is visible. It says entity A has got 20% interest in B. So can I say this becomes a PHI? Because you've already got 20% stake, that is a previously held interest. Subsequently, A further acquires a 50% share in B. So 20% was already there, then another 50% acquired, makes it a total of 70%, which means 30% is NCI. The fair value of the assets acquired in the liability assumed is given. So these are the assets acquired and these are the liabilities. And the fair value of the entity as a whole is given. And the fair value of the NCI is given. And then it says fair value of the PHI is also given. It's all given on a proportionate basis. 400 crores is the business value, 20% NCI. 400 crores business value, 30% is the PHI. Sorry, 30% is NCI and 20% is the PHI. Entity A needs to determine whether acquisition is an asset acquisition as per the concentration test. So as usual, what we're going to do, we're going to apply a three-step model. I think I'm going to now put some questions to you. You can help me in applying the three-step model. Let's begin. So I think I'll do it out here itself, or maybe on the side. Okay, so let's, I think, do it on the side. Let's begin with the step number 1. So what I need to do, I need to add the purchase consideration. Rather, first we need to identify the individual asset rather. So can you first of all help me to identify the asset or a group of assets with a largest fair value? So look at the list of assets, building, cash and cash equivalents. So which asset do you think is got the highest fair value out of the list? And that's right. So we can say building is the asset with a highest fair value. Then we go to the step number 2, in which we've got step number 2, A, B, and C. So let's first of all add up the 3 elements. We add the purchase consideration, we add the PHI, and we add the NCI, all at a fair value. So let's see the sum total of these 3 elements. The purchase consideration is 300 crores, the NCI is 120 crores, and the PHI is 80 crores. So 120 plus 80 plus 300, I think that makes it a total of 500 crores, I guess. The sum total of all these 3 elements is 500. That's correct. Now let's go to the point number B. Now, which liabilities are you going to add? Are you going to add financials and a DTL? I did not make a mention, but I think you recall that when you add the liabilities, we do not consider any notional liability. So DTL is not going to be added. We're just going to add the financial liabilities, which is 800. So on the value in A, we add that 800, and this works out at 1300 crores. And then next we consider the reduction of the assets. Can I say the cash and cash equivalents will be reduced? So out of this 1300, the cash and cash equivalents of 200 gets reduced, and this works out at 1100. I think now we can easily get the figures. The building is supposed to be 1000 crores. So we can express the third point. So we can take building as a percentage of the gross PC. Let's see what is the percentage it is coming. I guess it is more than 90. So 1000 divided by 1100, this comes to approximately 91%. So this percentage is undoubtedly substantial in nature. So can I say it becomes a case of asset acquisition? The concentration test is met. You can say 91% of the consideration is concentrated in the building. The test is passed. It is not a business acquisition. It is an asset acquisition. Wonderful. So far, so good. So this is done. I don't think so. I've put any questions on the concept of IPO test. I thought IPO test is, sometimes gets a little more subjective. So I've just taken one element, and that is the concentration test. So far, so good. I guess we are ready to go to the next level now. Now, let's, I think, now start working on the step acquisitions, working on the step-by-step inputs on acquisition accounting. Now, once you've met the parameters of the mind map one, you said, yes, you've acquired a group of assets. Yes, it is a business. You've got control of the business. Then 103 is going to be triggered on the date of acquisition. But I think now, since you know the bigger umbrella, I think let's first of all, create a second mind map, and then we're going to start working on the asset acquisition. So let me make my mind map number 2. So I'm creating my second mind map number 2. So this is with reference to the types of accounting. This is with reference to the types of accounting which is given in the standard, including the appendix. Okay, now let me, I think, put some questions back to you. I would say the moment you look at the type of question, you need to see that is the transaction between related and unrelated parties. So I would say the focus point in terms of the second mind map is you need to see that is the transaction between. If you say the transaction is between unrelated party, or you say the transaction is between related party. So I'm going to make some statements. You can vouch me on that statement. So can I say if the transaction is between unrelated party, it is either a case of acquisition accounting or a case of reverse acquisition. If it is a related party, there is a possibility that it's a common control transactions unless the parameters are not met, in which case it will become a case of acquisition accounting or a case of reverse acquisition. Is the thought correct? So I would say the first instance, you need to see the transaction is between unrelated, related. If it is unrelated, common control cannot apply. If it is related, the possibility is to see whether it's a common control transaction. If not, it could turn out to be acquisition or a reverse acquisition. Agreed? So if it is unrelated, we can say the accounting is going to be either a case of acquisition accounting, or it would be a case of reverse acquisition, or it will be a case of reverse acquisition. It cannot be a common control transactions if it is unrelated party. If it is a related party, we can say generally. If it is a related party, we can say generally it's going to be a common control transactions. It's going to be a case of common control transaction. But if the parameters are not met, we can say if the parameters are not met. So if the CC, common control parameters are not met. So if you once identify the parameters of a common control transaction, so if the parameters are not met, then you come back out here and then you would see that either it's a case of acquisition accounting or a case of reverse acquisition. So what we're going to discuss first of all is the acquisition accounting, followed with a reverse acquisition, and followed with common control. So the flow of revisions is going to be acquisition accounting, then reverse acquisition, and then a common control. But the larger picture you need to keep is unrelated parties can be either of the two accountings. Related parties would generally be a common control if the parameters are met, and if not met, then it becomes either acquisition accounting or a reverse acquisition. So you cannot preclude the possibility of a reverse or acquisition accounting between related party transactions as well. Right, friends. So I think let's go further and let's now look at the concept of acquisition accounting. So let's look at the concept of acquisition accounting. So I think you would easily remember that in terms of acquisition accounting, we had the larger entry, that is acquisition accounting entry. And how many steps were there? I think you would remember that the entire acquisition accounting is divided in terms of how many total steps in nature. So we've got a total of 7 steps. That's rightly said.
7 steps.
That's wonderful indeed. So we will apply a 7-step accounting. So in terms of the 7-step accounting, we take the step number 1, and that is identifying. That is identifying date of acquisition, which is not going to be a big deal. So I think let me just map the thought process of step 1 here itself. So in terms of the step number 1, we can say the date of acquisition is when control comes. So you can say the date of acquisition is when the control arises. And generally, when you say the control arises, when does the control arise? So control arises generally when purchase consideration is discharged. When the purchase consideration is discharged, and that is the date when the control arises. So invariably you will see the control comes is the date when the PC stands discharged. But can the control come earlier before the PC is discharged? Yes. So there can be an exception as well. So we can say control can arise before purchase consideration is discharged. And can I say that would be a case when there is a mutual agreement between the two parties. But I'm not getting into those nitty-gritties. But basically, the date of acquisition in a larger question will always be given in the question. Then comes the step number 2, and which is identifying, and that is identifying what is called the accounting acquirer. The second step is in terms of identifying the accounting acquirer. For this, I think we'll make a quick chart. We'll make some summary charts on each and every steps on the 7th step. The third step is in terms of making, rather I would say, step number 3A and B. Do you remember what was step number 3A? Because we are making a list of the net assets. So if you remember what was there in step number 3A, Ind AS 12, you need to apply the deferred tax. Yes, you need to apply the deferred tax parameter, because as per Ind AS 12, you need to see that any asset whose fair value becomes the carrying amount differs from the tax base that would give rise to deferred tax implications. And then you make a list of net assets. We'll talk about this list of net assets also a little more detail, making the mind map. Then in terms of the step number 4, we need to calculate the purchase consideration. Then in terms of the step number 5, you need to calculate the NCI. Then in terms of the step number 6, you need to calculate the goodwill or the bargain purchase gain. Call it as capital reserve or call it as a bargain purchase gain. And then finally, in terms of step number 7, we need to put the acquisition accounting entry. We need to record the acquisition accounting entry. So all these are going to become the working notes in terms of the step number 7, where you consider the net assets at a fair value. You take the purchase consideration. You take the NCI gets a credit. So basically this entry is done on the date of acquisition, in the books of accounting acquirer. The focus is this is in the books of accounting acquirer on the date of acquisitions, and then you get the net assets PC NCI all from the working notes, and any balancing figure in this entry becomes a goodwill, or you can say a bargain purchase gain. Let's put it as a capital reserve. So these are the 7 steps which we need to apply before we reach this accounting entry, that is acquisition accounting entry. Now, step number 1, we have already mapped. So what we're going to do now, we're just going to create some mind maps on each and every steps. We'll start with the step number 2, go to the step number 3, and then 4, and then 5 and 6. 7, of course, is the consolidation part. So let's begin with now the mind map number 3. So this is my mind map number 3. Now this is based on the sub-steps of the acquisition accounting. So we are working on identifying the accounting acquirer. So we're working on identifying the accounting acquirer. Now I'm just going to make a quick chart based on this, but I can just connect the dots. So when you're looking at the accounting acquirer, your focus point is number 1, was a new company created or not? The focus number 2 is the purchase consideration is primarily in cash or primarily in shares. So when your focus is in terms of identifying the accounting acquirer, you've got 2 focus points at the back of the mind. So did you create a new company for the purpose of acquisition accounting? That's 1. And the purchase consideration is primarily in cash or shares, and you can get the results of the accounting acquirer. So I think let's put this in a small chart. So we can say the first focus is you need to see that the new company, is the new company created? The question is a new company created? The answer is a no, or the answer is a yes. So when you say a new company is not created, then the next question is the purchase consideration is primarily in which form? The purchase consideration is primarily in which form? Is it primarily in cash, or is it primarily in shares? Even if you create a new company, the focus point is the same. The purchase consideration is primarily in cash, or the purchase consideration is primarily in shares. Now, I think let's make some strong statements to you at this particular stage. Can I say if your purchase consideration is in cash, you create a new company, you don't create a new company, ultimately the legal and accounting acquirer is same. Agreed?
Yes, sir.
That's rightly said. So we can say in this case, as well as in this case, if your purchase consideration is in cash, we can say in this case, the legal and the accounting acquirer is undoubtedly same. Because you do not give shares, when you do not give them shares, they do not become the shareholders of your company. So you definitely retain a control of your own company. So when the consideration is cash, you don't need to apply the mind whether a new company is created or not. Legal accounting acquirer is same. Next, can I say if a new company is created and the purchase consideration is in shares, one of the existing companies will get a control over the new company. It is undoubtedly 100% a reverse acquisition.
Yes, sir.
Absolutely makes sense. So this is 100% a case of reverse acquisition, because one of the existing companies will undoubtedly get a control, maybe both put together get a joint control. And if the new company is not created and the purchase consideration is in shares, can I say depends? You need to calculate a percentage post-business combination and identify, correct?
Yes, sir.
That's right. So here I would say it depends. So you'll have to compute a post-business combination percentage and then decide. You'll have to calculate a percentage and then take a decision. So I think we can definitely make three important conclusions based on this particular input. Your PC is in cash, a new company is created or not, doesn't make a difference. It is undoubtedly a case of acquisition accounting. Number two, if your PC is in shares and a new company is created, it is undoubtedly a reverse acquisition. And if a new company is not created and the PC is in share, assessment of the percentage would be the deciding criteria. Okay, so I think I'm not doing questions on this step number two. So this is the step number two. So now I think we can go to the next step. That is step number three, which is a crucial step. And you can, of course, get questions independently on that. So let's make the next mind map. And my next mind map is the number that is 4. And this is on, I would say, step number 3A and 3B. Let's take it collectively. So that's on step number 3A as well as step number 3B. So step number 3A is supposed to be the application of Ind AS 12. And step number 3B is in terms of making a list of net assets. Now I think it's time for you to tell me a couple of things. So I think let's quickly run the concept of Ind AS 12 in the mind, and then we'll go to the list of net assets with considering the exceptions out there. Now, in terms of Ind AS 12, I'll just quickly, first of all, take a recap. So you can say if tax rate is given. So this step would apply only when a tax rate is given in the question. So the moment you're given a tax rate in the question, you need to consider that Ind AS 12 application is to be done. That's the triggering point. Now let's, I think, work upon when does it give rise to a DTA or a DTL as the case may be. So I think let's consider the case of a DTL and let's consider the case of a DTA. So let's talk in terms of assets and let's talk in terms of liability. So if you talk in terms of assets, when do you get a DTL? When the carrying amount is more than the tax base or the other way around? So can I say for a DTL, when the carrying amount, which is as good as a fair value, is greater than the tax base? Can I say this will be the other way around? And for liabilities, it is again going to be the other way around. So this is the case. The carrying amount in this case is greater than the tax base. So this is called a taxable temporary difference. So DTL arises when there is a taxable temporary difference, and DTA arises when there is a deductible temporary difference. So you need to make a walkthrough of all those assets and liabilities whose fair value, that is the book value, is different as compared to tax base. So I would say rather any asset or liability which has got a fair value and therefore the tax base will differ, so will lead to a deferred tax consequence. Okay. Now let's consider the list of the net assets. So when you consider the list of net assets, your focus point is we need the list of net assets on date of acquisition, and the thumb rule is we need it at a fair value. Okay, so now if you remember, there were 3 blocks under the list of net assets: recognition exceptions, measurement exceptions, recognitions, and measurement exceptions, just to connect the dots. When you say recognition exceptions, which means what is not in the balance sheet of the acquiree appears in the acquisition entry. Measurement exceptions the assets which will appear in the acquisition entry out of book value itself. And the recognition and measurement exceptions where the assets would appear which are not in the acquiring balance sheet would appear but not at a fair value at a different value. So let's, I think, quickly connect the dots and try to remember what were the items in the list. So there were three lists of items: recognition exceptions, measurement exceptions, recognitions, and the measurement exceptions. So these were the list of exceptions. So let's, I think, start asking you. You can maybe help me and keep revising and telling me what were the exceptions out there. So let's begin with your input. So first of all, can you tell me what was the recognition exception? That was fairly simple.
Contingent liability.
That's right. It was contingent liability. That was the only exception as far as recognition is concerned. So the contingent liability in the notes to accounts of the acquiree will appear in the acquisition entry at a fair value. Okay, next we're looking at the measurement exceptions.
Share-based payments.
That's right. So I think one of the most important, which I think we always remember, is NCA held for sale. So they would have been captured in the books of accounts at a fair value less cost to sell. So they would appear out here. And yes, you rightly said share-based payments, but I think since we decided to take it in the PC, I'm going to write it out, but I'm going to cut it out. So share-based payments, we will not consider in this list because we take it as a part of PC. So I'm just making a mention that this will be a part of purchase consideration. Anything else?
Reacquired rights.
Wonderful indeed. So we've got the reacquired rights that would appear out here. So we saw the case of a franchisee agreement and that would appear out here. Now on the recognitions and the measurement exceptions. One is related
Income
to
tax.
contingent liability.
Income tax.
Yes, that's right. One is the deferred tax, which is already in the step number 3A. Indemnification assets related to the contingent liability that would appear out here. Anything else?
Employee benefits.
That's right. The employee benefits under Index 19. And then there was also leases.
Leases.
That's right. So these were the exceptions. Mainly, of course, what you're going to see is you're going to see a contingent liability or sometimes a reacquired rights and maybe deferred tax and indemnification assets largely. You may not see all these items in the question, but mainly you could see these selected items. Okay. So this is on the step number 3A and B, which is first applying the principles of deferred tax. And then you need to make a list of net assets, including the deferred tax identified in step number 3A. Great. Okay, I think I'll not put questions on this area. That gets taken care in the larger questions itself. Let's go to the next mind map. So the next mind map is on step number 4. This is mind map number 5. So this is on the step number 4, which is on the calculation of the purchase consideration. Now this is the most crucial step, I would say. Just to recall the dots. Can I say purchase consideration is generally in the form of cash or in the form of shares? If it is in the form of cash, we'll take that. And if it is in the form of shares, we'll take the fair value of the shares which are issued. But apart from that, I think you'll remember that I gave you a list of certain number of issues which you need to take care in terms of purchase consideration every time. How many list of issues do you need to consider?
7.
7 issues.
Absolutely. So in this case, we can say the purchase consideration is going to be mainly in terms of cash, and we will consider the fair value of shares issued. So normally in a question, you're going to consider the cash component paid and the fair value of the shares which are issued. Apart from this, we said you need to consider a list of 7 issues as far as purchase consideration is concerned. So I think let's map up the mind in terms of all the 7 issues in this case. So 3, 4, 5, 6, and 7. Okay, so I think we've got a very interesting way of remembering them. So I think you can start the list. One is DC. Second is CCS, contingent consideration shareholders capacity. CCE, contingent consideration employee capacity. TC, transaction cost. PHI, and then it is supposed to be SBP, and then there was pre-existing relationship. Then there is pre-existing relationship. So these are the 7 agendas which we need to keep in mind. So we're going to talk now one by one on them, and we'll do a couple of questions on this area, especially on the concept of contingent considerations and in terms of this. Now, my mind is working on a very, very interesting chart indeed. Considering the impact of these items on the computation of PC, considering the impact of these items on the acquisition accounting entry, or maybe before the acquisition accounting entry, and also the post-acquisition accounting entry, shall I make a very larger kind of a chart giving you the inputs of what is done before the business combination entry, or on the business combination entry, or after the business combination entry? So you want me to make a larger chart? We're going to do it collectively if you say yes.
Yes, sir.
Wonderful. So what I'm going to do, I'll just make a consolidated wonderful chart on this. So let's make a interesting summary chart on these inputs. 7 issues, and we're going to see the impact of these 7 issues on the PC computation. So I think let's take one column on computation of PC. Then one column we can say divided in 3 subparts. Pre-business combination, on business combination, and post-business combination. So we will make an interesting summary chart. Let me give you the structure. So I am looking at the list of those 7 issues in terms of step number 4, that is the calculation of the purchase consideration. Then I'm looking in terms of the step number 7. This is pre-business combination. This is on date of acquisition. That is acquisition accounting entry. And I'm looking at post-business combination. So your step number 7 gets divided in terms of 3 parts: before the acquisition date, on the acquisition date, after the acquisition date. So this becomes pre-business combination, on the acquisition date, and post-business combination. So before that, I think let's also understand and make a simple little chart, first of all, to begin with. So let's talk about these 3 issues and just quickly take a little recap on the understanding of these elements as well before we go further. Okay, so at the first instance, I had given you a 3-step model. I've given you a 3-step model in terms of identifying these 3 parameters: step 1, step 2, and step 3. So at the first instance, you're going to put a question that is the payment going to be made now, or is the payment going to be done later? Can I say if it is done now, it's neither DC nor CC. If it is later, you need to go to step 2. It can be DC, it can be CC. The second step is when you look at this point, now we say that is it conditions based? It is conditions based. So when you say it is condition based, we say no, it's not condition based, or we say yes, it is condition based. If you say no, it's not condition based, then what is it? There are no conditions attached. A payment is later with no ifs and buts. DC.
DC.
And if it is yes, we go to step 3. It can be a CCS or a CCE. Then you need to see the conditions. What conditions are there? So we need to see what conditions. So if there is a service condition and if there is no service condition. So if there is a service condition, what do you say? CCS, CCE.
CCE.
Wonderful. And if it is not, then it is CCS. So this is one inputs in terms of just trying to map the concept of DC, CCS, and a CCE. TC is in any case never a part of PC. This is never taken as a part of the PC. PHI is supposed to be taken at fair value. So this is a case of step acquisition, though we'll talk a little more on this later. And share-based payments also we can say it is a part of PC, but can I say pro rata? It is taken at a pro rata fair value. It's taken at a pro rata fair value in this case. I think that will map up in the summary chart. And pre-existing relationship, can I say in this particular case, when you see the pre-existing relationship, it depends upon whether it is contractual or non-contractual in nature. So it depends upon is it contractual or non-contractual in nature. So just put the basic parameters, the details we'll put in the summary chart. Okay, so now I think we're working upon these 7 issues. We'll go through the application of these 7 issues in terms of the step number 4, that how do you take care of them in the purchase considerations, and then what is the impact on the journal entries in terms of step 7 before the business combination, on the date of acquisition, or after the date of business combination. Now, let's proceed. So I think let's begin with the very first agenda, and that is deferred consideration. So when you look at the deferred consideration, can I say it is definitely a part of PC, and that is at a fair value. And what is a fair value? It is the present value of future. It is a present value of a future payment. So in this particular case, it's undoubtedly a part of purchase consideration at a fair value, which is the present value of the future payment. So any impact in terms of step 7? Nothing pre-business combination, nothing post on the acquisition date, any impact on the post-business combination?
It forms part of PC on date of acquisition.
Sorry?
It forms part of PC on date of
Yes, of
acquisition.
course, on the acquisition date. So I think I'll not put a cross. So I think let's put this. That it is a part of PC. Anything which happens post business combination? That's the most crucial point. So because when you get a larger question, you're going to see the impact of that. UOD.
Unwinding.
Yes, it is supposed to be UOD. There is going to be unwinding of discount. Because when you take a fair value that is a present value, unwinding of discount will take place. So you'll put the entry finance charge gets a debit and DC gets a credit. So this is going to be post-business combination accounting. So you need to be very clear in terms of the role of this item in the PC computation and what happens on the 7th entry at acquisition, before, or maybe later. Next. So next I am looking in terms of CCE. Is that a part of the business combination? What is paid in the employee capacity?
No, sir.
No, it's not a part of PC. So can I say if it is not a part of PC, there is no impact on this. But is there going to be any impact in a post-business combination period?
Ind AS 19 or 102 will.
Yes, you're right. So I would put it as Ind AS 19/102. That's right. Because if it is in the form of shares, then 102. If it is any other form, not based on the shares, it could be 19 employee benefits. Great. Okay, so this is the second element. Now let's go to the third element. We need to make a similar chart. So we'll map all these seven issues.
So on the last chart, once I was noting.
Oh, sure. This is definitely going to help us in a larger questions. Your mind has to be very crystal clear in terms of the movements which are happening. Done.
Yes, sir.
Great. So this is step number 4, and then we divide this in 3 sub-steps. So this is my step number 4, that is on the PC calculation. This is on the step number 7. There is pre-business combination, that is date of acquisition, and that is post-business combination, and the list of 7 issues. Now comes the interesting one. That is CCS. Now, in terms of contingent consideration in the shareholder's capacity, is that a part of the purchase consideration? Undoubtedly, yes.
Yes, sir.
It is a part of the purchase consideration, and that is at a fair value. By the way, is this a financial liability as per 109? The contingent consideration paid to the shareholders, would that be a financial liability as per 109? It can be
Financial liability or equity instrument.
yes, or can be equity instruments as per Index 109. So that was just a hint towards the subsequent accounting. So you need to make an assessment, financial liability or equity. We'll see how do you decide that in the subsequent accounting. Okay, so anything to be done on a pre-business combination? No. And on the date of acquisition, it's a part of the purchase consideration. Now, anything to be done in a post-business combination? Of course, yes. First, you need to take a call that is it equity or is it financial liability? If it is equity, no remeasurements will take place. But if it is a financial liability, then what is the category of this financial liability? AC, FPTPL. Any inputs on that? I didn't get any inputs on that.
AC, sir.
No. It's FPTPL. These are financial liabilities, FPTPL. So you need to see that first of all, you classify that is it supposed to be a financial liability or is it equity instrument? So can I say if the mode of payment is cash, if the mode of payment is supposed to be cash, or the mode of payment is supposed to be variable shares, then it is supposed to be financial liability. And if the mode of payment is supposed to be fixed shares, if it is supposed to be fixed number of shares, then it is equity instruments. So what you need to do in this particular case, identify the category, whether it's a financial liability or equity instrument, because this step can be independent questions in the exam. So if it is supposed to be a financial liability, it is measured at FPTPL. It is measured at fair value through P&L, which means that any fair value changes goes to P&L. Any fair value changes will enter the profit and loss account in this particular case. And if it is supposed to be in equity instruments, can I say there will be no remeasurements? There is going to be no remeasurements in this case. Because then there is no need to update the value, it remains the same. So this is on the DC and the CCE and the S. What is done in step 4 and what is done in terms of step number 7. Okay, let's continue the chart. Can I take it further? So this is, I think, gives us all the details in terms of the 7 issues and what is done on each and every specific date. Let's continue with the chart. So we've got the list of issues continue, impact on step 4, and the impact on step 7. So this is step number 4, that is purchase consideration. Then this is step number 7, pre-business combination, date of acquisition, post-business combination, and the list of 7 issues with us. Okay, the next issue is pretty simple. That was TC. That is number 4. That is transaction cost. Is that a part of PC? Of course not. So this is not a part of PC. This is not a part of the purchase consideration. Now, in terms of pre-business combination, any impact? No. What is done on the date of acquisition? Any impact on the date of acquisition for a transaction cost?
Charge to P&L.
Charge of profit and loss debit. Bank gets a credit. So whatever TC is incurred is immediately expensed off, and there is no impact on the post-business combination. That is number 4. Then next, number 5. And this is on step acquisition. This is on step acquisition, or you call this as PHI. Okay, now I think my mind is working great in terms of PHI. Can I say there will be 2 cases, a conversion of a passive investment to control, or a conversion of significant influence to control. And we will see in both the cases what kind of entries will be done. So in terms of PHI, there will be 2 cases. So one is in general, but I think let's divide this in 2. So we can say it's a conversion of passive to control. It's a conversion of passive to control, or it's a conversion of significant influence to control. Can I say in both the cases, will you update the PHI at a fair value? Correct. So in both the cases, we will update PHI at fair value. In this case also, we will update the PHI at a fair value. Now, any impact in terms of pre-business combination. So when you're updating, can I say this updation will be more like a pre-business combination entry, correct? So would you like to tell me where will you take the impact? Can I say it depends upon Index 109? Whether it is accounted at FPTOCI NR or it is accounted at FPTPL, correct? If it is accounted in terms of FPTOCI NR, where will you take the gain or loss?
OCI.
That's right. The updation gain or loss goes in OCI, and if it is FPTPL, it goes to FPTPL. And by the way, what happens to the AOCI, accumulated other comprehensive income balance?
Transfer to retained earnings.
That's right. So accumulated OCI balance in tab 3 of statement of changes in equity is transferred to retained earnings in this case. So that's the only thing which you need to keep in mind. The gain or loss in the other comprehensive income and the accumulated balances will be taken in retained earnings. I guess no impact on the rate of acquisitions and no impact on the post-business combination as well. Now let's consider a significant influence to control. So can I say we would have been accounting this investment under which standard?
Index 28.
That's right. So in this 28, we would have been accounting using equity method. So can I say in this case, where will the gain or loss go?
P&L.
That's right. Anything else to be done in this particular case? Scrutiny of the accumulated OCI. distinguishing between recycling and the non-recycling component, because as a part of the equity method of accounting, you would have filtered what goes in OCI R and R, correct? So we can say that there is going to be scrutiny of accumulated other comprehensive income between R and NR. The R portion will enter the P&L,
PNL.
NR portion will enter the retained earnings. So these are two things which you need to do in this particular case. The revision in the investments goes in the P&L, and the scrutiny of the accumulated OCI in tab 3, you'll make a distinction between R as well as NR. And this is no impacts. So this is on the PHI. So you could get an independent question in PHI. You could get an independent question in terms of CC. So contingent consideration and PHI are the two important vital elements. Okay, so this is done. Let's go to the continuation of the chart. So now we're going to talk in terms of share-based payments. So sixth issue, that is SBP. So issue, step 4, and the step number 7. So this is step number 4, purchase consideration. Step number 7, that is pre-business combination, date of acquisition, post-business combination, and the list of 7 issues. So let's go to the next agenda, that is issue number 6, that is share-based payments. Is this about a PC? I would say depends. How many cases are there in terms of share-based payments?
3 cases.
That's right, there are 3 cases. One is mandatory replacement, one is optional replacement, and one is no replacement. So you can say one is a case of mandatory replacement. So one is a case of a mandatory replacement, one is a case of optional replacement, and one is a case of no replacement. Okay, in terms of mandatory replacement, is it a part of PC? Yes. So can I say
Yes, sir.
pro rata? So what I will do, I will take the fair value of original award on date of acquisition. I'll take the fair value of the original award on the date of acquisition, and we'll take a pro rata information. And what is that pro rata? Can I say vesting period completed in the numerator and divided by original or total vesting period, whichever is greater or higher? Greater. So we need to consider the original or the total vesting period, whichever is greater. So pro rata is a part of the PC. In terms of option replacement, would you take this as a part of PC?
No, sir.
No. And if it is a case of no replacement, is that a part of the purchase consideration? This is part of PC. And if it is no replacement, is it a part of PC or a part of something else?
Part of NCA.
That's right, absolutely. It is a part of NCI. The calculations is same, so I'm not repeating the calculations, but it becomes a part of the NCI. Okay, now let's see what is done in a pre-business combination. Nothing would be done in a pre-business combination. I think we'll just make a mention now what we will do in the entry. So in this case, it's a part of PC. In this case, it's not. In this case, it's a part of NCI. And now let's see the post-business combination. Any impact on the post-business combination with the mandatory replacement? Can I say 102 for the post-business combination portion? So for the post-business combination portion, can I say we would apply Index 102? And can I say in the second case for the entire portion? Can I say we will apply Index 102? And what about no replacement? Again, post-business combination 102. So in this case, for the post-business combination portion again, we'll apply Index 102. Wonderful. So I think this takes care of the inputs in terms of the issue number 6, that it is a share-based payment. You need to filter in terms of mandatory, optional, or as in the case of no replacement, and accordingly map whether it's a part of PC or a part of NCI. And 102 is going to be a common accounting for all the permutations combination. Wow. So now let's come to the 7th issue in the list. So let's go to the 7th issue. I think this is one of the longest mind maps in terms of the standard. And this is now pre-existing relation. Then I think we'll start doing questions on this area. So 7 issues. Step number 4, purchase consideration. Step number 7, pre-business combination, date of acquisition, post-business combination. So now we come to the 7th issue, that is pre-existing relationship. Pre-existing relationship. And I think you already know that pre-existing relationship will be divided in terms of 2 elements, non-contractual as well as contractual. Now, when you say non-contractual, what would be an example? Is a legal case contractual or non-contractual in nature? A legal claim against each other.
Non-contractual.
That's right. So we'll divide this in 2 parts. So we can say it would be either a non-contractual, or we can say it is going to be contractual in nature. Can I say if it is non-contractual, then what do we do? Generally, if I'm assuming in this case, let's take a presumption. Let's take a presumption for a non-contractual that there is a legal case by ICAI. So I'm giving you the inputs based on the presumption that there is a legal case by the ICAI. So what do you do in this case? Do you reduce the PC? Can I say we decrease the PC by what? Fair value. So whatever is the purchase consideration, that gets reduced by the fair value, because this will be settled earlier. So I think let's put it out here. So can I say the entry in this case is the liability will get a debit if there is a book value. The bank will get a credit to the extent of fair value. And can I say the balancing figure in this entry will go to profit and loss. So in this particular case, you'll segregate the fair value from the PC, then settle the liability. Liability will be given a debit at the book value, if any. The bank gets a credit on the fair value, so any difference goes in the P&L. Okay, now as far as contractual is concerned, can I say same treatment will follow? We will decrease the purchase consideration. And can you tell me by what amount will you reduce the PC? The PC is going to be reduced by the 2 elements, higher of the 2, lower of the 2.
Penalty or market value.
Whichever is greater or higher.
Lower value.
So we will take the penalty to exit. How much amount you need to pay to exit? Or we can say, we compare, you can say the fair value versus the book value. So we need to see the difference between fair value or the book value, whichever is lower. So this amount will get reduced from the purchase consideration. The entry, of course, would remain similar. So nothing on the date of acquisitions and nothing on a post-business combination as well. Right, so I think that maps up the elements of all the 7 issues. So now you need to be clear in terms of how do we tackle BC, a part of PC at a fair value, resulting in unwinding of discount. CCS is a part of PC at a fair value, classified as equity or financial liability, and if it is equity, no subsequent accounting. If it is a liability, FETPL. If it is CCE, then that's not a part of PC. Only 102 could apply, or maybe Index 19 could apply. If it is a case of TC, it is immediately expensed, not a part of PC. If it is a case of, you can say, a PHI, update the fair value. Look at the case. Is it a conversion passive to a control, or is it a cigarette influence to control? And accordingly, you need to decide the gains or losses are captured where. Then if it is a case of share-based payments, in those particular cases, mandatory, optional, or no replacement is the focus points. And accordingly, a proportionate amount of fair value goes in the PC or the NCI, or maybe nothing. And if it is a case of a pre-existing relationship, you need to filter between contractual and non-contractual and accordingly decide what is the reduction in terms of PC. And I think there's worth making another mention as well. Can I say this contractual relationship will also lead to something more? Would you like to tell me what? Can I say this could lead to reacquired rights? Am I right? This could also lead to reacquired rights, and that would be a part of, can I say, the list of net assets in step number 3B. So because it is contractual in nature, you also need to remember in this case that this contractual relationship could lead to a reacquired rights, a part of the list of net assets in that case. Okay, that's great. Now I think we're in a comfortable position to do a question review. Let's, I think, go to an interesting question now.
Sir,
Yes.
sir, when considering reacquired rights in step 3B, at what value we will record it, sir?
Fair value. We'll take the fair value.
Okay, sir.
And that fair value will be based on the remaining tenure of that right. So we see that, what is the fair value based on the remaining tenure? That would be given the question, but we'll take the fair value.
Okay, sir.
You're welcome. So now let's, I think, go to the question number 2, which is RTP. It's also in the education material. This is based on the concept of a contingent consideration. How should a contingent consideration payable in relation to a business combination be accounted on initial recognition and on the subsequent measurement in the following cases? It says on 1st April, A acquires 100% interest in B. As per the terms of the agreement, the purchase consideration is payable in 2 tranches. An immediate issuance of 10 lakh shares with a face value 10. A further issuance of 2 lakh shares after 1 year if the profits before interest and tax for the following year exceeds 1 crore. What is this? Is this DC or is this CC? After 1 year, with the conditions that the profits before interest and tax increases.
CC.
That's right, paid later, condition based, but it's not a service condition. So can I say it is CCS? Because the conditions attached is not service, but the achievement of a profit target. Then he says the fair value of the shares of A on the date of acquisition is 20 rupees per share. Further, the management estimated on the date of acquisition, the fair value of the contingent consideration is 25 lakhs. During the year ended March 17, the profit before interest and tax exceeded 1 crores and the fair value of the shares is now turned to 25 per share. So let's, I think, look at the clause A only at the moment. So let's, I think, look at the accounting for the clause A. We're looking at the initial and we're looking at the subsequent accounting. So I'm looking at the initial and I'm looking at the subsequent accounting. Now, when we say initial, it is 1st April 16. Subsequent means on the balance sheet date, that is March 17. I think let's begin the journey. It says on 1st April 16, A acquires 100% interest in B. And then it says there is an immediate issuance of shares. So we'll take the shares, immediate issuance of shares. So can I say 10 lakh shares are issued with a face value 10? But we're also given the fair value of the share is 20. So we would consider face value or the fair value of the shares.
Fair value.
That's right. So we'll consider the fair value on the date of acquisition. This comes to 200 lakhs. And then it says there is a further issuance of 2 lakh share. Is the number of shares fixed? Yes, it is fixed. If the number of shares is fixed, let me also ask you that is this supposed to be an equity instrument or financial liability? You're going to allot fixed.
Equity.
Equity.
Right, it becomes an equity instrument. So no remeasurements will take place at the end of the year. So it says 2 lakh shares will be given, and then it says that the fair value of this contingent consideration, CCS, on the date of acquisition is supposed to be 25 lakhs. So the purchase consideration is 225 lakhs. Now let's put the question directly to you. Any remeasurement will be done for these shares? Of course not. Any remeasurement to be done for the CCS on the balance sheet date? Since it is an equity instrument, can I say no remeasurements will be done? That's, I think, takes care of part number A. We'll be able to calculate the impact on the calculation of the purchase consideration. And since it is equity instruments, no remeasurements on the balance sheet date. Next, we go to the part number B. So now let's look at the data in terms of the part number B. Again, we're looking at initial and we're looking at the subsequent accounting. Okay, now it says in the part number B, containing the patterns, fact patterns in A above, the number of shares to be issued after 1 year is not fixed. That means it's going to be variable. So does that make it a financial liability? Yes. And that financial liability will be measured at FPTPL. And then it says, rather A agreed to issue variable number of shares with a fair value 40 lakhs after 1 year if the profit exceeds 1 crore. So now let's come back on the agenda. Is there going to be any difference in the PC? Does the PC still remain the same? Yes, of course. And when you look at the shares, they will not be remeasured. Are you going to remeasure the contingent consideration now, considering it's a financial liability and the fair values become 40 lakhs? Yes.
Yes, sir.
So this becomes 40 lakhs. So can I say there is an increase in the liability? So the entry becomes profit and loss gets a debit, financial liability gets a credit. With what amount? The change, 15 lakhs. So this is the remeasurement of the contingent consideration at the end of the year, considering it's a financial liability at FPTPL. Great. I know that was simple and straight. So that was on devoted question on a contingent consideration. Correct. Now comes another interesting agenda. So this was on CC. Now we come to a question which is based on PHI. So this is June 2019 examination question. I just made a theoretical input. I think before we read the question, let me just give you the dots once again. If it was a case of, a PHI, specifically, if it is a case of significant influence to control, so we said the fair value of the PHI will be updated. The gain loss goes in PL. And then any balance accumulated in the OCI in tab 3 needs a scrutiny. And that amount which is there in the OCI will either be taken to the P&L or retain earnings, depending upon it is a case of R or NR. So when it is a case of conversion, significant influence to control, scrutiny becomes, I think, the most important element. Let's now see. It says Deepak, an automobile group, acquires 25% voting ordinary shares. So it acquires 25% voting ordinary share. So when you say that you acquire 25% shares, that means you get a significant influence. And then it says, by paying 4320 crores on 1st April 17, Deepak accounts the investment using the equity method as prescribed under Index 28 because it becomes a significant influence. Then he says on March 18, Deepak recognized its share of net assets changes of Sean using equity accounting. So these are the three inputs they've taken. So what they've done, they've accounted for the change in the net assets. Now you very well know that in terms of equity method of consolidation, you track the changes in the net assets of the company. If the net assets of the company goes up, the investment goes up. The net assets of the associate goes down, the investment goes down. So in this case, what they've done, they've taken a share of profit or loss. So where was it credited? Can I say P&L? They took a share of exchange difference. So where was this credited? Of course, in OCI. But is this OCI R or NR? It's because of Index 21. The exchange differences in Index 21 is a case of R, NR. It's a case of R that's called what? FCTR, Foreign Currency Translation Reserve. Because when you apply Index 21, any foreign exchange gain loss arising is taken in the FCTR if it is a case of OCI. The normal exchange gain or loss on conversion of monetary item goes in the P&L, but this time he is very clearly saying it is other comprehensive income, which means it is a case of foreign currency translation reserve. So this is what is called FCTR, and this is called revaluation surplus. Sorry, this is share of profit loss. This is simply P&L, not revaluation. That's the next one. The share of revaluation surplus in OCI. So this also went in OCI, R or NR. I think this one you can tell me. Revaluation reserve in terms of Index 16 PPE, R, NR.
R.
It is NR. It is NR. So Index 16 is a case of no recycling. Then he says the carrying amount of the investment at the end of the year. So they've taken the sum total of all these changes, and that's the value in the books of accounts on the balance sheet date. Then he says on 1st April 18, it says Deepak acquired remaining 75%. So it's a step acquisition. You already had a 25% stake, you acquired another 75% stake in the company. And then it says for a cash consideration, fair value of the 25% already owned is given, and the fair value of the net assets is also given. How should the business combination be accounted for in accordance with the applicable index? Now, I would advise that in this particular case, you should put two separate entries. So updating the PHI is one, scrutiny of the OCI is two. So in the pre-business combination, do two separate entries, updating the PHI separately and also doing a scrutiny of OCI. So let's do two separate entries in this case. So we're looking at the entries in the pre-business combination. Now tell me, which values are you going to compare? So can I say this 25% of the investment is appearing in the books at 4779? The book value of this is 4779. And what is the fair value of this particular PHI? Can I say the fair value of this 25% is 4860? So remember, this is based on the value using the equity method. So as per Index 28, this is the book value using equity method of accounting, and we compare this. So let's see what is the difference. I think it's 81. So where do you take this gain? investment gets a debit. And where do you take this gain? Profit and loss. So this is updating the PHI. We have put a separate entry for updating the PHI. Now let's make a scrutiny in terms of the balances. Is there any accounting required for this 378? The share which went to the P&L? No. We just need to take care of the amounts which is accumulated in OCI. So let's take this difference in OCI. So there is a share of exchange difference. So can I say FCTR gets a debit? And where will you put this money? That is 54. RE or profit and loss? It's a case of R.
Profit and loss.
That's right. 54 goes in the P&L. And then the revaluation surplus will be transferred to the RE. So revaluation surplus gets a debit, RE gets a credit. I've given the name FCTR, but of course, this is nothing but OCI. This is also nothing but OCI. And this is to the extent of 27. So I've done two separate entries. One is for the upgradation of the PHI, and other is the scrutiny of the accumulation balance. Now we can put an entry for the acquisition accounting as well, since the net assets are given to me. So let's put the entry for the acquisition entry as well. So I think I'll just put it across. So my acquisition entry would be net asset gets a debit. So my net assets is 16,200 crores. And let's see the purchase consideration. So purchase consideration is a sum total of both the 25% fair value, which is 4,860, and you acquired the remaining at 13,500. That's, I think, 18,360. Is there any NCI left over now? No. We are at 25% stake. We acquired another 75% stake. I think that makes it a total 100% stake. So can I conveniently take the difference as goodwill? So we get a difference goodwill in this entry. That is 2160. That is the balancing figure. So I've done three separate entries, as you can see. Now, these two entries which are done is pertaining to the concept of, you can say, pre-business combination. And this entry is on the date of acquisition. Right, so I think that was another interesting question pertaining to the concept of PHI. So I think we've done a larger question on the concept of contingent consideration, a larger question on the PHI. Okay, I think now it's time to give you some break before we take some questions on share-based payments as well. By the way, I think I might be extending the class today because, a coming Sunday, I would be, taking half an hour earlier. So I think if you don't mind, I would extend the class till around 10:30. I hope that works fine with everybody.
Sure, sir.
Wonderful indeed. So I think let's give you a break, 10, 12 minutes, and then I join you back for the other nitty-gritties on the standards. Enjoy your break.
Thank you.
you had a relaxation of mind. So we were working upon the calculation of the PC. We have done some very interesting questions on the concept of contingent consideration and the concept of PHI. Another vital element in terms of the calculation is the share-based payment. So let's, I think, have a look at one of the questions on share-based payments. So you'll have to recognize which case is this as far as share-based payments are concerned. So let's have a look at the question number 4. It says on 1st April 2014, company ABC granted equity settled share-based payments with a grant date fair value of 1 lakh to its employee, which is subject to a 3-year service condition. Company XYZ acquires the entire shares of ABC, and as a part of the acquisition, it is required to issue equity settled replacement award to the employee. So what do you think it is? A case of mandatory, no replacement, or option replacement? It says it is required.
Mandatory.
Mandatory.
That makes sense. So this is mandatory in nature. And then it says, at the date of acquisition, the market-based measurement of the original award is given, and the market-based measure of the replacement award is given. And the replacement awards have got 1 year of vesting condition. Then he says, determine the amount attributable to pre-business combination and the post-business combination in a situation where all employees are expected to meet the service condition. Now, there is a total of 3-year service condition, and we're given the replacement awards have got a 1-year vesting condition. So how many years have already passed by? Out of these 3 years, how many years have already elapsed? It was granted on April 14, and we're sitting on the date of acquisition, that is 1st April 16. So can I say 2 years elapsed?
2 years.
And 1 year is yet to be elapsed. And the replacement award did not change the vesting period. The remaining period is still 1 year to go. So I think we're going to do the same calculations which we did in the regular sessions, that is applying a 3-step model. So let's apply a 3-step model to get the calculations. First, we're just going to organize the fair value of the original awards as well as the replace awards. Can I say on the date of acquisition? We'll just organize the data. So can I say the fair value of the original award is 1,80,000 and the fair value of the replace award is 2 lakhs on the date of acquisition. That is the first step. You just need to organize the data. Then we consider the pre-business combination portion. Can I say this is a part of PC? The pre-business combination will be a part of PC. So you will take proportionate of which value? The proportion of 2 lakhs or the proportion of 1,80,000?
Original awards 1,80,000.
That's right, 1,80,000. Vesting period completed is 2. Original and total vesting period is same, that is 3. So this comes to 1,20,000. So then we can go to the step number 3. So what relates to the post-business combination? Can I say that would be a part of the Ind AS 102 accounting? And for this, you will take which fair value as a base? Original or replaced?
Replaced.
That's right, 2 lakhs minus 120 in step number 2. This 80,000 is going to be spread over a period of 1 year because that's the remainder vesting period. That's what it says. What is the pre-business combination and the post-business combination in this case? Simple and straight. That was simple. Okay, now I guess we'll just quickly now go to the other steps. So I think out of all the 7 steps, I think 7 step, of course, is just a combination of all the inputs in the various 6 steps. But I think 4 steps are done. I want to now quickly make my mind map on NCI as well as on goodwill, connecting the impairment aspects as well. So let's do this in a combined mind map. So I think what was my last mind map number? Number 5. So I think let's make a mind map number 6, combining both the inputs in this case. So let's create a mind map number 6. So we've got a mind map number 6. Let's keep it separately for NCI as well as for the other. So I think we're going to get almost like nine mind maps, I think, as we've been doing consecutively in other standards as well. So I think the 7th one will be on the goodwill, 8th one will be on the reverse acquisition. So I think at least 8. So let's do this now on step number 5, that is on the calculation of NCI. Now, when you consider the calculation of NCI, what should come at the back of your mind is that there are two alternative ways in which NCI can be computed. One is you consider PASNA and one is you consider fair value. But this has got its own implications whether goodwill is full or goodwill is partial in nature. Though in terms of NCI, it does not make a difference. But when it comes to the goodwill impairment, then of course, we need to be careful how the goodwill impairment is allocated. That we'll see in the goodwill calculations. Right now, we're just looking at two alternatives in terms of calculating NCI. So the standard has given us two alternative choices in terms of calculating the NCI, alternative 1 and alternative 2. Alternative 1, fair value, and alternative number 2, that is PASNA, proportionate share in the net assets of the company. Now, the questions will always be clear. They will give you clear-cut instructions in terms of what you need to apply. So I think we don't need to bother about it. But I think let me ask you, when you calculate the NCI at a fair value. So can I say in this case, you take the number of shares held by NCI, we take the number of shares held by NCI and multiply this with the fair value per share, and you are able to get the NCI at a fair value. The next quick question is, when you take the NCI at a fair value, goodwill is full or partial?
Full goodwill.
Full.
That's right. And when you consider the NCI at PASNA, can I say we need to consider in this particular case the net assets as per step 3B. You've taken the net assets as per step 3B into the percentage which is held by NCI. So we consider what is the percentage stake which is held by NCI, and I think it goes without saying that goodwill in this case becomes partial. So I think this is one basic chain of thought which we need to keep in mind. I think I'm not doing any questions on this area specifically as an independent questions. It can be taken care in the larger questions itself. But I think just to connect the dots further, when the goodwill is full, can I say the impairment loss will be borne by whom? Just the parent or both parent and NCI?
Both.
That's right. Both by the holding company and NCI. But if it is supposed to be a partial goodwill, then we also need to consider that impairment loss is borne by parent company only. It is borne by the holding company only. NCI is not going to bear the loss. So that nitty-gritties, I think we'll see later. That is on the mind map number 6 on NCI computations. Great. Now let's go to the mind map number 7. Let's go to the mind map number 7, that is on goodwill. So I index mind map number 7, and that is on the step number 6 on the calculation of goodwill or bargain purchase gain. So in this case, you know that there is a simple and a straightforward input in terms of calculating goodwill. We've got a set format in which a goodwill is computed. But the only thing which we need to take care is once you compute the impairment loss. So what I'm going to do, I will divide this, into 3 learning points. One is how the goodwill is computed. Number 2, how the impairment loss is computed, connecting index 36. And then the allocation of the impairment loss. So we're going to connect 3 dots in this case. The computation of the goodwill, that's one. The second is the computation of the impairment loss, and then the allocation of the impairment loss, because it all depends upon full or partial. So in this particular case, let's first focus on computation of goodwill. So when you look at the computation of goodwill, so that's a standard format. You take the purchase consideration that's taken from the step number 4, to which you add the NCI that's taken from the step number 5. And that's irrespective, it is fair value, irrespective, it is at PASNA. Here it doesn't make a difference, it's just a figure difference. So here I'll just take the figures from the step number 5, add the sum total, and we will compare the sum total versus the net assets that is in step number 3B. And then we are able to get the difference, that's goodwill or a bargain purchase gain. Considering, of course, we're getting a goodwill. So can I say in this case that this is X and this is Y? So can I say you're going to get a goodwill when X is greater than Y? You're going to get a bargain purchase gain when X is less than Y. This is on the computation of goodwill. Here it doesn't make a difference whether NCI is PASNA or fair value, is just a format to calculate the goodwill. Now comes the crucial learning. Now we are looking in terms of the computation of impairment loss. Now we're looking in terms of the computation of impairment loss. And this is as per Index 36. So here the focus is now on the computation of impairment loss by virtue of Index 36. Now let's connect the dots. So can I say it depends if the NCI is at fair value, you're getting a full goodwill. And if the NCI is at PASNA, then you're getting a partial goodwill in this case. Now let's see how does this partial and the full goodwill is going to impact the calculations. Now let me remind you, we are focusing in terms of 36. So we're considering the subsidiary to be a cash generating unit. So in this case, we are considering that we're doing a impairment testing for a cash generating unit. The subsidiary is a cash generating unit. So what do? You take the net assets of the CGU, which is the subsidiary company in this case, and to this we add the goodwill. And this goodwill is already a full goodwill. And then you compare this with the recoverable amount, and you're able to get the impairment loss in this case. So nothing crucial, absolutely goes in a normal way. Now, tell me what will be the crucial point when you say that you take the net assets of the CGU, that is the subsidiary company, and to this we add the goodwill. Now, any specific inputs to be applied? This is a partial goodwill, so any specific inputs to be done at this stage? Grossing up. So can I say we need to go for a grossing up of goodwill, correct? This is what you learned in Index 36. I'm just trying to connect the dots. Because when you consider the application of goodwill computation, it is 103. But when you're looking at the impairment loss calculation, it is supposed to be 36. So when it is going to be a case of partial goodwill, you'll have to do the grossing of the goodwill before you do the impairment testing. You take the sum total, compare this with the recoverable amount, and you're able to get the impairment loss. I hope you're able to connect up with this. This is not 103, this is Index 36. So the only caution at the stage of impairment loss computation is if it is a partial goodwill, then you need to go in for grossing up of the goodwill at this particular stage. Now let's come to another crucial point. And this is the allocation of impairment loss. Allocation of the impairment loss is also by virtue of Index 36. The computation as well as the allocation, both is with reference to Index 36. Now watch this carefully, because this allocation is an important one to watch. Maybe we can take some figures to understand the nitty-gritties better. So we are considering that this is a case of full goodwill, and let's say this is a case of partial goodwill. And let's consider that A is got in terms of B, let's say 80% stake. So let's consider there is an 80% stake. I'll conveniently take some figures to elaborate the agenda. Now let's consider that you identified the impairment loss in this case, let's say to the extent of 200 lakhs. Let's say the goodwill in this particular case is to the extent of, let's say, 50 lakhs. So here, let's say the impairment loss turns out to be, let's say, taking different figures, let's say it turns out to be 240 lakhs. And the goodwill in this particular case is, let's say, 40 lakhs. Now, I think let's ask you some questions as well. So we know that when the impairment loss is allocated, we go with the instructions of the question, but let's say the instructions are not there. So you would first of all reduce the goodwill, and then you will reduce the other net assets within the CG in a book value ratio. So in this particular case, when you consider the allocation of the impairment loss, so when you consider the allocation of the impairment loss, so first of all, we will decrease goodwill, and then we'll decrease the net assets other than goodwill. We'll decrease the net assets other than goodwill, and that would be in the book value ratio. So I think now let's put the questions back to you. In this case, if the impairment loss is 200 lakhs and the goodwill is 50, can you tell me how much will you reduce the goodwill by?
50.
That's right. So we'll decrease the goodwill by 50 lakhs. And what about the net assets other than goodwill?
150 lakhs.
150 lakhs. Wonderful indeed. So there is no challenge when it is a full goodwill. Now let's consider the allocation of the impairment loss in this case. So first we'll of course decrease goodwill. Then we'll decrease the net assets other than goodwill. So we'll decrease the net assets other than goodwill in the ratio of book value itself. Now tell me, what is the amount of decrease in goodwill?
In the ratio of net assets?
No. How much is the amount of goodwill decrease in this case now?
We will gross it
30.
up now.
No. This goodwill is already, which is the grossed up goodwill. This is, let's say, the grossed up goodwill.
To the extent of 80%.
That's right. So can I say I will decrease a goodwill 40 lakhs into 80%? That is 32 lakhs. Wonderful. Here it was 100, here it is 80%. And what about the decrease in the net assets? Is it going to be 240 minus 32 or 240 minus 40 itself? Remember, this
240
is after grossing of the figure.
40.
So this is after grossing of the figure. So minus 40, so 200. So we'll decrease the assets, net assets by 200 lakhs itself. Now the only input which needs to be seen at this stage is, can I say this loss will be borne by, can I say both parents and NCI? This is borne by both holding company and NCI. Can I say as far as this goodwill is concerned, it's borne by, can I say holding company only?
Yes, sir.
And as far as the net asset is concerned, borne by both holding and NCI again? Right, so I think that is the dots which you need to connect. I gave you the inputs in terms of 3 sub-steps in terms of things. So when you look at the concept of goodwill, how it is computed doesn't make a difference whether it is partial or full. NCI figure doesn't make a difference. But when it comes to the computation of impairment loss, you need to be careful if it is partial goodwill grossing up. And when it comes to allocation, then also you need to be careful that out of this 240, 40 is towards goodwill, but we'll take 80% of that. Remaining 200 is the decrease in the net assets. I hope I stand clear.
Sir, remaining impairment loss of 8 lakhs is to be allocated to NCI.
In this case,
Yes, sir.
no, nothing.
In partial.
No. In terms of partial
Sir,
goodwill, the NCI goodwill is not even there in the balance sheet. So NCI gets no share.
sir, but we have impairment loss of 240 lakhs. We have allocated only 232 lakhs, no, sir.
No, but you see, okay, let me explain. Now, basically, what you've done in terms of partial goodwill, the net assets, let's take the net assets to match the figures. The impairment loss I've taken is 240. And let's consider if the impairment loss is 240, just go for the calculation of the figure. Let's consider the recoverable amount in such a way. Let's say the recoverable amount is 1000. So this is 1240, correct? Right? So I've taken the impairment loss as 240. So recoverable amount is 1000. Net assets including goodwill 1240. And this grossed up goodwill is 40. And this is supposed to be 1200, right? Now, what's this? Is this 40 goodwill appearing in the balance sheet? Or is this 40 after, grossing up the goodwill by 80%? Can I say it would have been 32, right?
Yeah.
Take 32 divided by 80% is 40. So you must have taken 32. So goodwill in the balance sheet is only appearing at 32. So you cannot write off the goodwill of 40, you'll write off 32. And therefore, we have written off the goodwill to the extent of 32.
Okay, sir. Yes, sir. Got it, sir.
Great. Okay, so I think all my 7 steps are done. I think the 7th step is already done. So I think what I have done is taken care of all the 7 steps with you. So we've seen the nitty-gritties on each and every step, what are to be done. I think the acquisition accounting summary is done. Now we're ready to do a question on this. So I think let's first do a question on a complete 7-step model as far as acquisition accounting goes. Let's now take a practical illustration. Okay, let's go to the question number 7. So let me first zoom this across. I hope it stands visible, right?
Yes, sir.
Okay.
No, sir, you have to increase a little bit of size.
You get cut out. I think, let me see. This one will get zoomed. This is
Yeah.
visible, right?
Yes.
Previous one, I think, then we'll have to cut it more. Is it good to go?
Yes, sir.
Okay. Let's now read the inputs in this particular case. So I'm just going to read the inputs out here. And let me just, I think, first read the facts of the case and then go ahead. So it says the balance sheet of professional and dynamic on 31st March X2 is given. So I'm not looking much at the information on the balance sheet within. I'm just going to go to the other information at this stage. So it says Professional Limited acquired 70% shares of Dynamic on 1st April X2. By the way, this is the balance sheet on March X2. So this is the very next day. By issuing shares in the ratio of 1 share for every 2 shares of Dynamic. The fair value of the shares of Professional is 40 rupees per share. The fair value exercise resulted in the following. The fair value of PPE is 350 lakhs. Professional also agreed to pay an additional payment as a consideration that is higher of 35 lakhs and 25% of any excess profits in the first year after acquisition over its profits in the preceding 12 months by Dynamic. So now look at the sentence very carefully. It says Professional Limited agreed to pay an additional amount, which is the greater of the two amounts, 35 lakhs and 25% of any excess profit. Does this mean that you will end up paying 35 lakhs in any case? Because when you say that you'll give them 35 lakhs or 25% of the excess profit, whichever is greater, does this mean that 35 lakhs is bound to be paid?
Yes, sir.
Correct? So the 35 lakhs indirectly will become a deferred consideration, and if there is any amount which is payable in excess, because let's say if 25% of the excess turns out to be more than 35, then that excess is something which is contingent. So I would say this consideration is a blended DC and a CC put together. Because in this particular case, when you're looking at that minimum payment of 35 lakhs will be made, it becomes a DC. And 25%, if it is more than 35 lakhs, will become a CC. And that is dependent upon a condition which is not a service condition, so it would be a CCS. Then he says this additional amount will be due after 2 years. Dynamic has earned 10 lakh profits, it says, in the preceding year, and it expects to earn another 20 lakhs. So I think even if you consider that they will earn 20 lakhs in the future, so 25% of 20 lakhs will come to just 5 lakhs. So I think they're bound to pay only the 35 lakhs. They will not be liable to pay any excess because 25% excess is below 35. Then he says, in addition to the above, he also agreed to pay one of the founder shareholder a payment of 20 lakhs. And then it says, provided he stays with the company for 2 years after the acquisition. So what is this? If he's a founder shareholder, that means he's the employee come the shareholder of the company. So is this in the nature of CCE or a CCS?
CCE.
That's right, because you are putting a service condition that you need to work for another 2 years. So it becomes a case of CCE in this case. Right. Now let's go further. Dynamic a certain equity settled share-based payment award which got replaced. When it says it got replaced, what does this mean? Optional or mandatory? It got replaced.
Mandatory.
Right. It mandatory by the new awards issued by profession. As for the original term, the vesting period was 4 years, and on the acquisition date, they've already served 2 years of service. As for the replace awards, the vesting period is reduced to 1 year from the acquisition date. The fair value of the awards is given. So this is the fair value of the original and the replaced awards. Dynamic has a lawsuit pending with a customer who's made a claim of 50 lakhs. Management estimated the fair value of this liability. If there is a lawsuit pending with a customer, what does this indicate? What is the nature of this liability?
Non-contractual.
Contingent liability, I would say.
Yes.
So it's a contingent liability where I have the fair value, so it will become a case of exception to the step number 3B. Then the applicable tax rate is given, which gives rise to deferred tax implications. You're required to prepare the opening consolidated balance sheet on 1st April X2, and we're given a 10% discounting rate as well. Okay, so what we need to do is just need to apply the 7-step model, apply it thoughtfully, step by step by step, you'll get the results. Let's, I think, begin. This is question number 7 actually. So let's start the answer. So we're looking at the solution to the question number 7. So we're going to apply a 7-step model and just keep thinking in a chronological order to get the results. Let's begin. So we've got the step number 1. Can I say step number 1 is first of all to get the date of acquisition? I don't see that there is any challenge in the question to get the date of acquisition. We're not given anything contrary. So can I say the point number E itself says that we acquired 70% shares on April X2. So I think we can conveniently say 1st April 2000 X2 is the date of acquisition. Correct.
Yes.
Then we go further. So then we go to the step number 2. And in terms of the step number 2, we will get the accounting acquirer. So let's identify the accounting acquirer. So let me put some questions across to you to identify the accounting acquirer in this case. Are you creating a new company? No. Is the consideration primarily in terms of shares? Yes. So we're clearly given that professional is going to acquire 70%, issuing the own shares. So no new company is being created and we are giving the consideration primarily in shares. So do we need to assess it is acquisition accounting, reverse acquisition? The
Yes.
consideration is in shares?
Yes, sir. Assess.
Yes,
Maybe
sir.
you said.
Absolutely. So what we'll do, we'll make some calculations regarding the pre and the post business combination. So we'll see what is the status of the percentages pre and post business combination. So first of all, we can say that there is no new company. And secondly, we can say that PC is primarily in shares. It is primarily in shares. These are the two focus points as of now. So can I say the shareholders of the main company, that is legal acquirer, had 100% stake in their own company. Now let's see the status and number of shares. There is, I think, a slight misprint. What I think the input should be, the shares of, I think, professional is 10 rupees each, and the share of dynamic is 100 each. So this is a face value 10, and this is the face value 100. So this has got 50 lakh shares, and he's got a total of 4 lakh shares. So we acquired 70% shares by giving one share for every two. So let's, I think, work out the data. So earlier, all the 50 lakh shares, earlier we can say all the 50 lakh shares, 100% was there with the shareholders of profession. So now we can say they've got 50 lakh shares. And can you tell me how many shares have been issued to the shareholders of the acquiring company? They had a total of 4 lakh shares, but I did not acquire all the 4 lakh shares. So can I say I acquired 70% of the shares and we issued one for every two shares? Is the calculation correct? So we acquired 70% shares, we issued one for every two shares. So how many shares have been issued? I think 1.4.
1.4.
Yes, so if you look at the percentage post-business combination, by giving them the shares in your company, your percentage definitely dilutes, but you're still in control of your company. So can I say this indicates that the control is retained? And the control is retained, can I undoubtedly say the legal and the accounting acquirer is same, correct? So I think this calculation needs to be done just to give us support that the accounting and the legal acquirer is same. So we can say professional limited in this case becomes a legal and the accounting acquirer as well. Wow. So I think this is to begin with the step number 1 and the step number 2. Now we go to the step number 3A. Since a tax rate is given, you need to organize all those assets and liability which fair value, that is the book value, differs compared to the tax base. So I think we'll divide the step number 3 in two parts. So we'll consider the step number 3A, that is on the calculation of the deferred tax. And we can consider the calculations of the step number 3B, which is making a list of the net assets in this case. Okay, so I think let's begin the journey. So in this particular case, let's, I think, go back and see wherever the assets fair values are different compared to the tax base. I think one is in point number B, the fair value of the PPE is given. It's 350 lakhs. But I think if you look at the fair book value of the PPE is 500. So can I say the balance sheet value becomes a tax base? Because from the income tax point of view, the deduction they will give you is based on the original cost itself. So this indirectly becomes a tax base, and you can say this 350, the fair value becomes the book value. So we can organize a small little chart in this case, just to get the inputs. Let's see the item. So we'll compare the carrying amount, tax base, get the differences. So let's take the item, the carrying amount. So item is PPE. So carrying amount will be taken as a fair value. This is equal to the fair value. Then there is a tax base, which is 500. You get a taxable or a deductible temporary difference, and accordingly you get a DTL or a DTA as the case may be. So in this case, the carrying amount is less, resulting in a taxable or a deductible difference.
Deductible.
That's right. So this becomes a deductible difference of 150 and putting as deductible temporary difference. Tax was, I think, at what rate? Taxes, I think 30%. So 30% of this would mean 45. So DTL or a DTA?
DTA.
That's right. So this becomes a DTA. So this is one item resulting in a deferred tax. Let's go back to the other items. So I think there is nothing out here, but I think in point number E, there is a contingent liability whose book value is 0, but the fair value is 5 lakhs. So we've got another item that is contingent liability. The fair value is 5, the book value is 0. In this case, it's a liability with a carrying amount greater. Does this also lead to a taxable or a deductible difference? Can I say deductible difference again? 30% would mean 1.5 DTA.
DTA.
That's right. So the overall DTA is going to be 46.5 is the deferred tax asset. Okay, that's great. So this gives me the input in terms of the deferred tax implications for all those assets and liability whose book value, or you can say the fair value now, is different as compared to the tax base. And now we go to the list of net assets. Let's now see the balance sheet items. So I think except for this machine and the contingent liability, everything seems to be at the book value. So I think I'll just maybe keep the figures in front of me. You can also maybe keep this in front of you. Or you can just, I think, maybe take a snapshot and start giving me the figures, I guess. EBE is 350, investment is 100. So PPE is 350, investments is 100. Then next in the balance sheet, we're given inventories 150, trade receivables 300. Inventory is 150, trade receivable is 300, cash and cash equivalents I think is 100. Then I guess others are 230. So we take others as 230. And DTA we can consider is 46.5. So I think that's all on the asset side. Now let's go to the liabilities. So in terms of liabilities, we have given long-term borrowings is 200, long-term provisions is 70. Long-term borrowings is 200, long-term provisions is 70. Then I think we can take the contingent liability as well in the meantime, 5. Then there is a deferred tax 35, short-term payables and trades payable is 300. So there is already an existing DTL that's 35. And there is short-term provisions and there is trades payable. That was I think 150 and 300 if I rightly remember. Yes, the short-term borrowings are 150, trade payables is 300. So this is short-term borrowings 150. I think that's it. We have taken care of all the assets and liability, including the deferred tax asset, which was there in step number 3A, and including the contingent liability, which has got a fair value, and the PPE, which has got a fair value. So I think this will give us the net assets at this stage. So 350, 100, 150, 300, 100, 250, 46.5. Is it 516.5? I think it's correct, right? So this is step number 3B. Correct. Okay. So this is step number 3B, getting the net assets. Now we come to the step number 4, that is PC. So I think before we calculate the purchase consideration, let's make a list of all the 7 issues. So we'll make a list of all the 7 issues. So first we'll consider the PC is in the form of shares, then we can take care of the 7 issue. So I think what I remember, there were a total of 4 lakh shares and we acquired 70% of the shares, giving 1 share for every 2 shares. And let's see what is the fair value of the shares. So we acquired 70% shares and we gave 1 share for every 2 shares at the rate of 40 rupees per share. So this is at the rate of 40 rupees per share. So this will give us the fair value of the shares issued.
56 lakhs.
That's right, it is 56 lakh. Then I think I'll take a list of all the 7 issues. We'll see if it is applicable. We'll keep taking it. But let's, I think, take a recap in terms of all the 7 issues and then we'll start fitting them in between. So one is DC, one is CCS, one is CCE, then the other one is TC, then the other one is PHI, then the other one is SBP, and the other one is pre-existing relationship. So once we write down, our focus is very clear and we can just, I think, take those plus and minus to get the element of purchase consideration. So I think there was a deferred consideration. If I remember, 35 lakhs is what we identified as the DC, which is payable 2 years later, so discounted for 2 years. So 35 lakhs discounted at 10%, it's 28.93. Then I think contingent consideration employee, of course, is not taken. TC, of course, is not taken. PHI, I don't think so. There is any PHI in the question. And I think there is no pre-existing relationship as well. Now let's go to the CCS and SBP. Back to the question. So I guess we're looking at the point number B, where it says professional agreed to pay an additional payment. So we have taken the 35 lakhs already. And then, in addition, we are giving a payment to the founder shareholder. That is for a stay. This is CCE, not to be taken. So I think we just need share-based payments. So we're going to replace the new awards, and the original term is 4 years, and they've already served 2 years. And we've given the fair value of the original award and the replaced award. So we take a proportion of this 5 lakh. So 5 lakhs into what? So this is going to be 5 lakhs. What is the vesting period completed to?
2
And
by
the total vesting period is 4. That comes to 2.5. That's it. Nothing else is defined. So I think that will give us the amount of purchase consideration. It's 87.43, I guess. Right, so this is done. So that focuses on the step number 4. Now we're ready to go to the step number 5. Now, the step number 5 is in terms of calculating the NCI. Is it PASNA or is it fair value? I don't think so. We're given any status of fair value in the question. So I think with the absence, it has to be PASNA only. So we'll take the NCI at PASNA. So let's take the net assets from the step number 3B. 6.5. So can I say the net assets is 516.5 and the NCI is 30%? Let's take 30% of this. 154.95, and then we can calculate the step number 6, and that is on the calculation of goodwill, and that's going to be simple and straight. Right now impairment does not make any difference to me. We're just organizing the inputs, so we're not concerned with the aspect of impairment. Just put in the figures. So we take the purchase consideration, that is 87.43, and this we add the NCI, that is 154.95. So we get the sum total, compare it with the net assets. So 87.43, 154.95. This is
242.38.
2.8 compared with the net assets, that is 516.5. So we're getting a capital reserve, right? 274.12 is the bargain purchase gain, that is capital reserve. Okay, so this is done. I guess we get the status till step number 6. Now, the question is not asking you to put an entry, it is asking you to make a consolidated balance sheet. So first, I think we'll put the entries, then make the balance sheet. So we go to the step number 7 and look at the acquisition entry. So let's organize the data based on the previous steps. So we're going to consider the net assets, and then we're going to consider the purchase consideration, the NCI, and we consider goodwill as a balancing figure. Do we have all the data organized with us? Net assets is 516.5. So we are getting a capital reserve. NCI is 154.95. PC was
87.43.
87.43, and the capital reserve, I think, 274.12.
Yes, sir.
So this entry in any case should tally. We can just still psychologically just take the total, though it should 100% agree. Yes, it is tallied. So this is the entry. Now let me, I think, make a statement, because the question says we want a balance sheet on the acquisition date. So can I say, if you take the balance sheet, that is the standalone balance sheet of Professional Limited, and to this I add this entry as per Ind AS 103, are you going to get a consolidated balance sheet of Professional? What do you say? Just take the standalone balance sheet of Professional, add 103 entry, you get the consolidated balance sheet of Professional. Is my thought correct?
Yes, sir.
That's
Yes.
right. So basically, Ind AS 103 acts as a bridge between the two financial statements, the separate and the consolidated financials, and when on the acquisition date, you incorporate this entry. So I think maybe you can do this. So you're going to see the interesting part, how you can make your consolidated balance sheet in the exams without going wrong. So what we can do, take the asset side, this is the standalone, this is the 103 entry. So that's going to give us a consolidation. We can go step by step on this. So this is the consolidated balance sheet on date of acquisition. This is the Ind AS 103 journal entry. And this is the separate financial statements on as good as 1st April X2, though it is given in the question 31st March X2. So let's begin with the asset side of the balance sheet. So I think I need to take the question in front of me just to relate it well. Let me just open the question. Right, so I think let's begin with the asset side of the balance sheet. We've got property, plant, equipment. So if you look at the balance sheet of professional, it is 300. And I think here we took 350, right? As per the journal entry, that makes it 650. Then the next item in the balance sheet is investment. The balance sheet investment is appearing at 400. And I think in the acquisition entry, it was 100. That makes it 500. Then next, I am given inventories. I'm not showing the headings of current and non-current assets, just for convenience. So inventories is 250. This is 150. So this works out at 400. Then next, we are given trade receivable. The trade receivable is to the extent of 450. And that is 300. That makes it 750. Then I think there is a cash and cash equivalents. That's, I think, to the extent of 200 and 100. Might feel that I'm picking up the figures from the standalone financials of Dynamic. I'm not, for convenience, but I'm focusing on the journal entry. Then there is others, and that is to the extent of 400 and 230. Is there anything else on the asset side? I think there was a DTA, if I rightly remember. And is the DTL more than the DTA? Then we can net it off maybe. I think yes, right? The DTL in the balance sheet is more, I think. DTL, I think, is appearing in the balance sheet at around 75. So DTL was, I think, 46.5. So we net it off. So we can get the sum total of the asset side. 650, 500, 400, 750, and 930. This is 3230. Now let's go to the liability side of the balance sheet. So we've got equity share capital. I think equity share capital, and there is another thing which needs to be done at this stage. We need to put an entry for discharge of the PC as well. I think let's do one thing. Let's put an entry for discharge of PC. So can I say PC gets a debit? We allotted equity shares at a premium. And then there is a DC as well. And then there is a share-based payment. So SBB reserve will also be given a credit. So let's see the bifurcation of the PC, 87.43. How many shares did we land up issuing in the PC?
One lakh.
This was 1.4. Yes, 1.4 into 10 is the face value. So 1.4 into 10, 14 is the face value, 42 is the premium, and share-based payment was 2.5. What was the DC figure? 28.73. 28.93 is DC. So this is the bifurcation of the PC discharge. So 87.53 minus 14, 42, 28.93. Yes, that's telling. So I think we'll incorporate this entry in the balance sheet as well. So equity share capital in the balance sheet is appearing at 500. Then I think we took another 14. That makes it 514. Then I think there is other equity. So can I say in this other equity, you've got 810. Now what is to be taken in 810? Can I say in terms of 810, what do we need to include in terms of 810? We need to add the element of DC, sorry, not DC, SBP reserve. So we take SBP reserve, and we also take the share premium 42. Anything else? Anything else which needs to be taken? Anything else which needs to be taken in this other equity? I think that's it. So 810 plus 2.5 plus 42, that's 854.5. Okay, there was a bargain purchase gain also, no? How much was the bargain purchase gain, capital reserve?
274.12.
74.12. So all this is going to be a part of other equity, the SBP reserve, the share premium, etc. So this is 810, 2.5, 42, 274. This is 112, 1128.62. Right, so this is done. Then we give them the long-term borrowings, long-term provisions. So long-term borrowings is 250 and 200. That makes it 450. And then next we are further given, it is long-term provisions 50/70. That is 120. I think I need a little more space to go further. So let me just add on more inputs. So liability side continued. Separate financials, 103 entry, consolidate financials. So there is a DC. So I think DC would also be appearing out here. DC was 28.93, correct?
Yes, sir.
So that is another liability. Then I think there is a DTL. The DTL is appearing to the extent of 40 and 25. Then there was a DTA 46.5. So we can take this net figure. This is 28.5. Then I guess we're given the short-term borrowings and the short-term payable, the trades payable. So short-term borrowings is 100 and 150. This comes to 250. Then there is trade payable 250 and 300. That works out at 550. Hopefully the balance sheet should agree. 514, 1128.62, 250, 120, 28.93. 514, 1128.62, 570, 28.93.
Sir, we have to consider non-controlling interest also.
I missed NCI, that's right. So there is NCI as well. Let me put that NCI. What was the NCI?
154.95.
154.95. Correct. So 514, 1128.62, 154.95, 450, 120 plus 28.93, 28.5, 250, 550. This is coming to 3225. There was a contingent liability also, right? That was 5. So contingent liability we can add in the trades payable. So this will be 555. The balance sheet is agreed. 3230. That is the total of the consolidated balance sheet in this case. Wow. Okay, so that takes care of a good question on the consolidated, I would not say consolidation, acquisition accounting, but a consolidated balance sheet on the date of acquisition. Okay, I hope you're feeling confident in terms of the agenda now, considering the revision of all the 7 steps, etc. I hope you're able to catch up with the dots.
Yes, sir.
Yes, sir.
Yes, sir.
Okay, now we are going to go to another question on reverse acquisition or maybe a common control. If you're feeling heavy, then we'll go to the common control. If you're feeling okay, then we can go to reverse acquisition. So what do you want me to do at this stage?
Reverse
Reverse,
acquisition.
reverse acquisition.
Acquisition? Okay, done. Then let's go to reverse acquisition. Let me just, I think, zoom this to the extent we can. Yes, visible, right? Is it good to go?
No, sir. Not visible.
Let me then, I think, slightly cut it down. I'll cut down the requirement of the question.
Yes, now visible.
Now, fine.
Yes, sir. Fine.
Okay, so let's now read the inputs in this case. It says on 30th September X1, entity A issues 2.5 shares for each ordinary share of B. So we're issuing 2.5 shares for each ordinary share of B. That is the exchange ratio which is given. Then it says all the entity B shareholder exchange the shares in B. Therefore, A issues 150 shares for all 60 shares of B. The fair value of each ordinary share of B is 40 and the market price of A share is 60. The fair value of A's assets and liabilities again. Now that is one thing which is slightly going to give you a hint, because if A is giving the purchase consideration and we see that the fair value of A itself is given, this is a very subtle hint in terms of saying it's a reverse acquisition, because if you get the fair value of the company which issues the shares, that is indicated that he might become an accounting acquirer. Then he says rest of the values, book values are same except the fair value of non-current assets, 1500. The balance sheet of A and B immediately before business combination is given, and he's very clearly said that A is the legal parent but accounting acquiree. B is the legal subsidiary but accounting acquirer. Then he says assume that entity B earnings for the annual period is 600 and the consolidated is so and so. That's all about EPS. So I think I am more concerned with now looking at the balance sheet of the company. There is a consolidated balance sheet on the date of acquisition. So let's, I think, begin with the inputs in this case. Now, my first question to you, do I need to prove that it is a reverse acquisition or can I directly accept the fact?
We need to prove it.
And why do we need to prove this? You're
We
right.
need the percentage calculation.
Yes, because for the PC, I'll need the calculations of percentages. So in any case, we're going to prove this. Great. So let's work this out. We're going to go to the step number 1. So in terms of step 1, we're going to go to the date of acquisition. So I think the date of acquisition is very clearly stated. So we're given that we have acquired on 30th September X1. So date of acquisition is 30th September X1. Then we go to the step number 2, that is calculating the accounting acquirer, identifying who is the accounting acquirer. Just to get the focus points clear, is there a new entity created? No. The consideration is primarily shares? Yes. So we need to get the percentages. So we can say no new company created. No new company is created and The PC is primarily in shares. The PC is primarily in shares, so we need to do the workings, comparing the pre and the post business combination entries, percentages. So let's see what is the status of the pre and the post business combination. Pre business combination and post business combination. So let's get back to the balance sheet to see the status of the shares. A has got 100 shares and B has got 60 shares. So A had 100 shares in the company. So all these 100 shares, 100% was held by the shareholders of that company. But now, can I say they've got 100 shares, and what is the new number of shares in the company? So they have issued, I think, 2.5 shares for every one share against the shareholders of B. Shareholders of B have got 60 shares. You gave 2.5 shares for every one. I think that makes it a total of 250.
250.
So the percentage drops to 40%. So can I say the control is lost? The company from 100% falls down to 40%. I think that undoubtedly proves that it is undoubtedly a reverse acquisition. So if it is a case of reverse acquisition, we can clearly say that in this case, B is accounting acquirer. So in this case, B becomes the accounting acquirer, though he is a legal acquiree, but he becomes an accounting acquirer from the perspective of 103. Okay, so that is the step number 2, identifying the acquirer. Let's now go to the step number 3. So are we given any tax rate in the question? No. So I'll still divide the step 3 in 2 parts, but we're not given any tax rate. But I think just to follow the consistency of the solution. So in terms of step number 3A, can I say there is no tax rate? Since there is no tax rate, so there will be no deferred tax implications because tax rate is not given. Then we go to the step number 3B and we make a list of net assets. So are you going to take the net assets of A or the net assets of B?
A.
Yes, we're going to take the net assets of the accounting acquiree. So we're going to take the net assets of A. So I think we're just given one fair value, rest all book value. So as far as the non-current assets are concerned, it is 1500. So current assets is 500. So current assets is 500. Non-current assets, we've taken the fair value, that is 1500. Then I think on the liabilities, we just have the current liabilities 300. Non-current is 400. So current liabilities 300. Non-current liabilities 400. So we can get the status of the net assets as well. So that is, I think, 1300. Right, so 2000 minus 700, 1300 is the net assets. So that's, I think, pretty simple and straight. No complications so far. Now we go to the step number 4, which is the crucial step in terms of calculating purchase consideration. Now let's go to the step number 4, that is purchase consideration. Now, I think earlier when we did this question in the regular sessions, of course, we made some detailed inputs, but now we're going to directly come to the computation itself. This is a reverse acquisition number 1, and the consideration is primarily in shares. So what comes to your mind? When it is a reverse acquisition, are you going to consider in this particular case the consideration given or the consideration which would have been given?
Would have been given.
Correct. And then considering that the purchase consideration is only in shares, are you going to consider the consideration, the fair value of what is given or the fair value what is acquired? Because the PC is only in terms of cash. So when it is only in terms of cash, the second focus point is to take the fair value of what is given or the fair value of what is acquired.
What is acquired?
What is
That's
acquired?
right. So we're going to do the calculations in two parts to the examiner, showing in both the parts. So in this particular case, we need to first of all consider the fair value of what would have been issued, the fair value of what would have been issued to maintain same percentage. So we will take the fair value of what would have been issued to maintain the same percentage. And then we will take the fair value of what is acquired. And why we are doing this calculation, fair value of what is acquired, for the reason that purchase consideration is only in shares. So we have done the funda that if the PC is only in shares, your PC is not the fair value of what is given, but the PC is more reliable, the fair value of what is acquired. And let's first of all consider what would have been issued to maintain the same percentage. So we want to see that if B would have given shares to the shareholders of A, what would have been the status? Can I say the shares of B is to the extent of 60? So he's got a total shares in the company 60. So we can say he wanted to maintain, let me back on the number of shares. Yes, the number of shares in the company B is 60. How many shares he would have given to the shareholders of A to maintain the same percentage? So he would have given, let's say, X number of shares in such a way. How much percentage did he want to maintain? Post business combination, A gets a 40% stake. So can I say B indirectly gets a 60% stake? So he wanted to maintain a 60% stake in the company. So let's see what will be the value of X. I think it's 40 shares. So B has got a total of 60 shares in the company. If he would have issued X number of shares, this would have been the total shares. Oh, sorry, I need to take this in the denominator. So let's say he would have issued X number of shares to the shareholders of A. So he will be left with 60 out of the total number of shares in such a way that he gets a 60% data. So now let's calculate the purchase consideration. If B would have issued 60 shares, what is the fair value of B? So let's see what is the fair value of B in this case. The fair value of B is 40 rupees per share. So he would have issued a total of 60 shares at the rate of 40. The purchase consideration would have been 2,400. So this is based on the status that if you would have issued shares to the shareholders of A in such a way to maintain a 60% stake, you would have given 40 shares. So in this case, 40, sorry, I have written 60 shares. So much noise. So this is 40 shares into 40, that comes to 1,600. I hope the calculations are correct.
Sir, can you explain this point once again, sir?
Yes,
Yes,
add to
sir.
that. If you go back to the calculations, you can see that as far as B is concerned, A got a 40% stake in the company, so B is getting 60% stake. So when this business combination occurred, the effective percentage B gets in the combined entity is 60%. So he wants to maintain that same percentage. So we said B has got 60 shares in the company. Let's say he issues X number of shares to the shareholders of A in such a way that he's maintaining that 60%. So he would have ended up issuing 40 shares to the company, to the shareholders of A. Correct? So 40 shares would have been given by B at the rate of 40 per share. The PC becomes 1,600. Right? Did you get that? Okay. Now coming to the point, can you tell me that if B would have issued 40 shares to the shareholders of A, what does he acquire in return? Does he get the control over all the shares of that company? would he get a control over all the 100 shares of A? Is that correct? B would have got control over. B would have got control over, can I say 100 shares of A? Is the thought correct? Nobody votes me for the second part, since the beginning. So if B would have given these shares, he would have got a control of 100 shares of A. So what do we consider? 100 shares of A into the fair value of A. And what is the fair value of A? I think it is 16. So this is coming to 1600. So is this coming by chance, both the values, or are they got to be the same?
Got to be.
Because the exchange ratio is based on the market value. So since it is based on a market value, this is bound to happen in this case. This is the only crucial point in terms of purchase consideration in a reverse acquisition. Now we go to the step number. Yes.
One question, sir. Are we going to give both the calculations or we can do one calculation?
No, you'll have to give both. Because you'll first give this calculation, then you will make a mention. This is more reliable in nature. So you're going to do this calculations as well.
So second one is more reliable.
Yes.
So if we give second one, what difference does it make, sir, in terms of examination answers?
What the study material has also done, they've given the calculation number one, and then they've said that, this is more reliable in nature, but by chance the calculations are same. So I think the only good effect to you is that you'll be able to get the correct answer. 99.99% the answers as per left and right will 100% match. But there is a still 0.1% chance that they do not match. That would be only if the exchange ratio is not based on a market value. But I think it is advisable as a cross check that you show this calculation as well as this calculation, though I think independently this is good enough, but I think it will help you in a cross check.
No, that I understand. But what happens if they don't match, sir?
Then you need to consider this one.
So, in any case, we are going to do this. That is the
So
whole
you
point.
can do this also. I
Yes,
mean,
sir.
technically, if you do this, this is perfectly fine. But then I think as a cross check, it is better. But if you say that you want to do only this, it's
No, it is because of the time constraints, no, sir. There is.
Yes, you can do that. So.
Thank you.
Thanks. Okay, next we come to the step number 5. And step number 5 is on the NCI, but I don't think so there is any NCI, right? We acquired the entire company, so there is no NCI. Then we go to the step number 6, which is on the calculation of goodwill, which is pretty simple and straight. Just apply the basic flow and get the goodwill calculations. So we take the purchase consideration, add the NCI, there is no NCI, versus the net assets, and we're able to get the goodwill. So purchase consideration 1600, there is no NCI, and I think net assets was 1300. So I think we're getting a goodwill to the extent of 300. And in terms of reverse acquisitions, if you remember, even in the regular sessions, we said don't get into entries. In reverse acquisition, do only the 6 steps and then make the consolidation. So now let's make the consolidated balance sheet as well. So we'll make a consolidated balance sheet, nothing much in terms of the balance sheet. So we'll go back to the status in terms of the balance sheet data. Now, there are some crucial points which you need to consider when making the balance sheet of the consolidation. You will incorporate the fair value of the accounting acquiry A. But when you consider the share capital, the number will be in accordance with A. So you will take base as company B. You'll take the book values of B at the fair values of A. So accounting acquiry being A, you take the fair values of A. But when it comes to the share capital, you take the share capital, the number based on A. So let's, I think, begin the journey. So non-current assets, current assets. All right, I think let's go with the non-current assets. Non-current assets is 1500 plus 3000. So we take care of the non-current assets, fair value 1500 plus, I think, let me keep the balance sheet in front. So this is 3000. So that comes to, I guess, 4500. And then I think there is current assets in the balance sheet. Before that, we'll take goodwill. Goodwill is, I guess, 300. Current assets, there is no fair values given. So 500 plus 7. So that comes to 1200. So I think this is on the asset side of the balance sheet. That, I guess, comes to 6000 is the total of the assets. Now let's come to the liability side of the balance sheet. So we've got equity share capital. Now be careful on the number. So how many shares does company A has got? He's got total of 100 shares and he issued 150 shares. So can I say this is the number of shares in the balance sheet? The number of shares in the balance sheet will be from the point of view of the legal acquirer. A has got 100 shares. He issued 150 shares to the shareholders of B. So number appears in accordance with the legal acquirer. Next. So as far as the amount is concerned, we'll take it from B's point of view. So the share capital earlier, I think, was 600. PC was 1600. That makes it 2200. And then there is retained earnings appearing for B. Retained earnings is 1400. And then there is non-current liabilities. The non-current liabilities are to the extent of 400 and 1100. No fair values are given. So that makes it 1500. And then finally, we also get the input, and this is current liabilities. So as far as current liabilities are concerned, that is going to be 300 plus 600. So that makes it a total of 900. So this will give us the total of the balance sheet. So 2200, 1400,
It is
1500.
telling, sir, but can you explain the equity capital part?
Yes, I'll do that again. When you consider the equity share capital, the focus is number and the focus is amount. When you consider the number, you need to consider from the point of view of legal acquirer. That is A. A has got 100 shares in the balance sheet plus he issued 150 actual number of shares to shareholders of B. So number is purely from the point of view of A. As far as the amount is concerned, this is from the point of view of the accounting acquirer, that is B. So share capital of B plus the PC. So I think just to make a quick pointer, this is from the point of view of, you can say, A, legal acquirer. And this is from the point of view of B, accounting acquirer. That's the main focus point on the number as well as on the amount. Amount will be from the accounting point of view. Number will be from the legal point of view. So this is from legal acquirer and that is from the accounting acquirer.
Yes, sir. Thank you. Thank you.
You're welcome. So I think the balance sheet is agreed. Reverse acquisition without a creation of a new entity is taken care. So what we've done is all the 7 steps of acquisition accounting, and I've also exposed you to a complete question on acquisition accounting and a complete question on reverse acquisition. I think if we get time, we'll do another question maybe on a reverse acquisition where a new company gets created. But I think one question, of course, on a common control. So next class, we'll do that, and then we'll also switch over to the concept of consolidated financials. Now, for the consolidated financials, I was wondering, if you want, we can do a larger big question as well. Maybe we can do some past examination questions. And maybe I can do a comprehensive question on an income statement and a consolidated balance sheet. Something, which is not exactly examination level question, but larger than that. So if you want, you can let me know. I can do that kind of larger questions. We'll stick to examination kind of questions. But if you want me to do a question which contains a lot of adjustments, and which is a much higher in level but contains more adjustments, we can do that.
So we can stick to the examination questions as of now, if possible, sir.
So
But
definitely.
containing as many adjustments as possible for the consolidation part, मतलब covering all the
So
adjustments.
we'll conceptually discuss all the
Yes,
adjustments.
yes,
But I
yes.
think we'll stick to the examination questions.
Correct, sir. Correct, sir.
Well taken. Well taken.
We are short of time, sir. I mean, you are short of time also, sir. That way.
I
sir.
know time is the biggest sense. Correct. Right. So I think that's all for the day. Unless you've got any questions to ask. So I think our next session happens to be on Saturday. I guess Thursday there's no class. So we'll meet you on Saturday in the morning.
Thank you.
Thank you, sir.
Right.
Thank you.
Thank you very much. See you on that Saturday. Thank you. Bye bye. Take care.
Thank you.
Thank you, Ji.